next year you have the hallmarks of a potentially pretty exciting year.
Balanced portfolios make a lot of sense heading into 2026.
Setting this up for a year where you're going to see a lot of churning, but have moderate returns.
We see a huge amount of appreciation across the AI names. There's a question of which ones and how long can that run for.
Respect the trend, but don't ignore the risks as we go into 2026.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Happy holidays, happy new year. Good morning. Welcome to Bloomberg Surveillance on this holiday Monday, closing out another year of double-digit returns. Stocks stalling out a bit to start the final week of 2025. Gold and silver losing a bit of luster after an unprecedented run. Investors casting doubt on the depth of the debasement trade and pressure for peace between Russia and Ukraine, resulting in hopeful rhetoric, but few definitive resolutions. Good morning. John is out on paternity leave. Anne-Marie is on holiday. We are playing tag this month, but we got lucky today. And joining us is Matt Miller, co-host of Open Interest. Matt, thank you so much for being here. What a ride it's been. It seems like this is a market that is struggling to get to some sort of final finish that can push to new highs.
Yeah, absolutely. I mean, the Santa Claus rally, right? Last week felt like it was in full swing, but actually the Santa Claus rally is only officially the last 5 trading days of December. So we've only seen 2 so far, and the first 2 of January, according to Yale Hirsch from the Stock Traders Almanac. So we're up a little bit in the first 2 days of that, but I think investors still have high hopes for the next 5.
Thank you for the technical analysis of Santa Claus rally, because ultimately that is what we're going to be looking for, is some sort of culmination to a year of another double digits, the third straight one for both the S&P and the NASDAQ this morning. Just failing to really pick up steam right now. You are seeing slight declines across the board, but betting on that broadening out trade. This to me is interesting. Russell 2000 futures almost flat, even though S&P futures are down about 0.25%. 10-year yields lower 4.1%. The idea of how much we've gained. It's actually been, Matt, the best year for bonds going back to 2017. So for all the people talking about the debasement trade in U.S. Treasuries, we really haven't seen that with this bet that next year we will get a Fed that is accommodative.
Yeah, it's pretty impressive. I often look at the chart from the beginning of the cutting cycle. So we're down, I think, 175 basis points in the Fed funds rate from September of 24. And yet the 10-year yield itself is actually up about 50 basis points. So if you bring it out, obviously you can cherry pick depending on whatever dates you pick. But if you bring it out to the beginning of the Fed cutting cycle, it hasn't helped much in terms of yields.
Which really raises a question next year about what's going to matter most, the Fed or the 10-year. Meanwhile, a big question around the debasement trade, and you have seen that silver and gold issue kind of percolate after going parabolic. You suddenly saw this real removal from that froth, down about 5% on intraday trading of silver. There is a question about the debasement, and yet the dollar has pretty much traded sideways since Liberation Day. Coming up this week, what we have is not a stocked plate. What we are looking at is jobless claims on Wednesday. Before that, we get Fed meeting minutes, get some housing data, but otherwise pretty light on that. Also focus very much in Washington, D.C., and we will be getting more on Ukraine and Russia and a possible peace there. Coming up this hour, Cameron Dawson of New Edge Wealth with stocks near record highs. Bloomberg Skylar Montgomery Koenig with the dollar on course for its weakest year since 2017. Plus, our conversation with JetBlue CEO Joanna Garrity on the airline's outlook for 2026 and beyond. We begin this hour with stocks stalling out after approaching new record highs. Cameron Dawson of New Edge Wealth writing, the biggest question for 2026 is whether or not everything else can strike back and deliver the earnings growth that is necessary to unseat the narrow Mag 7 leadership next year. Cameron, I am so pleased to say, joins us now. Cameron, thank you so much for being with us, and happy holidays. Great to see you. This broadening out trade and the real question behind it, when will we get the data and the information to understand whether it really is valid?
It really is a show me story in 2026 as to whether or not the equal weight S&P 500 can deliver on what are some pretty high expectations for earnings growth next year. If you look over the last 3 years, you've been in an environment where the largest parts of the market have driven the vast majority of the earnings growth, which is why you've had the vast majority of returns come from these Mag 7 names. But that's expected to narrow, not quite flip, but narrow in 2026. So you can see it in something like the equal weight S&P 500 having expectations for revenue growth to accelerate from 1.5% in 25 up to 5% in 2026. So a lot is riding on this idea of EPS delivering. And of course, that will be a show me story as we move through the year to see if there is upside to those numbers, or if yet again we'll be in an environment where Mag 7 gets revised higher and equal weight gets revised lower.
So you add to this story something that happened last week. There actually was a big piece of news last week. NVIDIA had this agreement with Grok, which is a chip designer, some $20 billion valuation of this company, doubling it over the past couple of months, and raising questions about the dominance of NVIDIA, but also whether there is a shift in narrative around the AI story to one that is more efficient, more useful, and cheaper for some of the end users.
I think no better way encapsulates this idea of potentially a narrative shift is looking at some of the non-profitable AI-related names. They, of course, were leaders coming out of the April lows and saw an absolute frenzy as we moved into the fall with September and October rallies that were truly eye-watering. But what's been fascinating is that they have not participated in this latest move higher. If you look at something like the Goldman Sachs Non-Profitable Tech Index, or look at something like ARK, those indices have not made new highs, which just suggests that maybe, just maybe, there's some rationality entering into this market, which we would welcome and see as a good thing, because that kind of rally in unsustainable, unprofitable names is not something that we would see as healthy for the market.
What do you expect from M&A in, I mean, not just the Mag 7, but in AI? I was pretty stunned after seeing that Grok deal when I looked on the FA function on the Bloomberg terminal to see free cash flow at NVIDIA is just gone parabolic, right? Last year it was 27 billion. This year it's 60 billion. Next year it's expected to be 95 billion. I mean, they are just raking in cash and are able to deploy 20, 30, 40 billion dollars without even thinking about it.
Yeah, I think it's a really good question, and it raises the question of where we sit in the semiconductor cycle, because we do know that at the end of the day, semiconductors are a cyclical business. And if you go back to prior cycles, you typically do see earnings grow by 100, 120% plus in up cycles. Then, of course, you do hit an inevitable down cycle. And we're now in an environment, if you look at the overall SOX index, that earnings are up about 150% off of the late 2022 lows, which just suggests that possibly we are closer to the end of this semi-cycle than we are to the beginning. But I think it's also very arguable that this semi-cycle will go further and last longer than prior ones, simply because of the secular tailwinds of something like AI. But it's important to remember that it's always this time is different with cyclical areas. If you remember last time, it was the Internet of Things and we were putting chips in everything, and that's why we weren't going to have semi-cycles anymore. I think the real question will be is how much further can this go? And is that free cash flow that NVIDIA is generating today something that we can extrapolate into perpetuity? Possibly not.
What happened, Cameron, to the terror of Liberation Day? I mean, the economic uncertainty that we were all wringing our hands about, right? These tariffs that admittedly have been muted a bit by the drop in the dollar, almost 10% year to date. Is any of that a concern next year, or have we realized that it's actually no big deal?
I think that if we were to see the tariffs as a concern, it's really captured in this conflicting kind of headline. We got a headline over the weekend saying that bankruptcies are at their highest levels since 2010. And then you pull up corporate profits in overall in the US, and they're at new highs. And so this suggests that tariffs are hitting things like smaller businesses harder. They're also hitting smaller consumers harder, who have a higher propensity to spend of their overall incomes. So when you put that together, it really encapsulates this idea that tariffs exacerbate the K-shaped economy. They hurt lower income consumers, they hurt smaller businesses much more than they hurt larger businesses and higher income consumers.
I just wonder, Cameron, how long you can see this rally continue unless you get participation that does broaden out. This idea that you can see an economy that's growing at the fastest pace in 2 years on headline GDP. Yes, it's noisy, but a lot of it's data centers. It's not actually the mom and pop stores that are declaring bankruptcy.
The one thing that does give us a little bit of solace in thinking about this broadening out is contrasting where we are today in breadth measures versus where we were last year. Last year at this time, you only had about 20% of names trading above their 50-day moving average. It was an incredibly narrow market, which we thought made it more fragile. If you look today, that stat is at 64%. So it doesn't necessarily mean that we are immune to everything, but it is encouraging that we are seeing broader participation in the rally, that it's not resting on just a small handful of names. So using the banks as example, if the economy was really falling off a cliff, we don't think that we would be seeing bank earnings revised higher nearly as much as they are and banks hitting new all-time highs. Some of that rally might be a little bit extended. But I think it's important to note that there are still some signs that cyclicality is being well bid in the equity market, which just give us a little bit more comfort that things aren't as extended or maybe broadening out in a better way. Cameron
Dawson, with sun pouring in from a lovely place wherever you are, we will be sticking with you. You will be sticking with us of New Edge Wealth. Matt, you talked about the Grok deal with NVIDIA, and I found this just fascinating. What we saw last week on Wednesday night. It was almost like trying to be buried, right? That NVIDIA would enter into a non-exclusive licensing deal and hire most of Grok's employees. Grok is a language processing type of outfit, and this idea that they are trying to get more competitive with the likes of Google and their chips in a way that could avoid some sort of antitrust claw. It just highlights how dominant they are with the cash that you were talking about.
Yeah, I think it was a really fascinating deal. The timing was an interesting part of it because it's largely gone unnoticed, right? And yet it was a huge $20 billion deal. The thing is, they just have so much free cash flow. In fiscal 27, they're looking at estimates are for $150 billion. So you see a lot of these big AI companies, including OpenAI, doing deals quickly, reportedly without many lawyers or bankers, and spending a ton of money because they want to take advantage of the valuations and the cash they're getting right now.
And they can get the dominance of the field, given the fact that they have that endless cash and they're doing it to try to solidify some of the potential competitive threats. We'll kind of parse through this throughout the show, because I do think just because they bury it doesn't mean that we have to bury it. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Good morning, Lisa. President Donald Trump says Ukraine and Russia are, quote, closer than ever before to a peace deal, but said it might take a few weeks to get it done. Ukraine's President Volodymyr Zelensky says the peace framework is 90% agreed and that U.S.-Ukraine security guarantees are 100% agreed, but major sticking points remain, including the future of Ukraine's Donbass region. Meanwhile, Israeli Prime Minister Benjamin Netanyahu meeting with U.S. President Donald Trump at Mar-a-Lago today to discuss issues in the Middle East, including Gaza and Iran. The meeting comes as tensions between the two leaders have increased, with Trump having previously warned Israel against taking actions that could undermine his peace efforts, and Netanyahu facing political pressure at home to take a tough stance on Gaza and Hamas. And China kicking off maneuvers around Taiwan, including live fire drills near the Taiwan Strait. The move comes after the U.S. announced a major weapons package for the self-run democracy. Taiwan's presidential office called the drills a serious threat to peace and stability. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. Up next, closer than ever for Ukraine.
I really believe we're probably, Mr. President, by far closer than ever before with both parties.
20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees 100% agreed. Prosperity plan being finalized.
We've got more on that just coming up next. Bloomberg's Tyler Kendall joins with some of the details from New York. This is Bloomberg Surveillance. Welcome back. What we are seeing this morning is stocks trying to get back to that fervor. That Santa Claus rally that Matt was just explaining does consist of now. This is the race into year end. It is not continuing with some of the fervor that usually happens at this time of year, down about 0.25% for S&P futures. But interestingly, Russell 2000 futures unchanged. And this, to me, Matt, is really the question. Can you get that broadening out that so many people are counting on to really lead the market higher in 2026? And if you can't, is it still sustainable?
Yeah, actually, the small caps, though, have done really well over the last couple of months. In hopes that the Fed would continue to cut, right? Their help's the most. I think 40% of the Russell 2000 is unprofitable or some giant figure like that. So they really need those rate cuts. And that's where the Fed really matters going into 26.
So let's take a look. 2s, 10s, and 30s. What you have seen is a rally. You've seen the best year for Treasuries wholesale going back to 2017, although Matt could point out that at the beginning of the cutting cycle, maybe it sort of fudges exactly where we've been. Nonetheless, you are seeing that 2-year yield pegged at 3.5% or just below 3.47%. The 30-year yield has hovered, though, around that 4.8%. To your point, Matt, there is a feeling that just cutting on the front end is not going to help the long end, especially with ongoing questions around who the buyer base is going to be next year for Treasuries.
Yeah, you know, it's interesting. Cameron Dawson mentioned that story that I think more than 700 companies have filed for bankruptcy this year. And they listed the reasons. Inflation was number one, but rates were number two before tariffs. I thought that was really interesting. So if rates continue to come down, that'll be really helpful, obviously, to the smaller businesses that have gone bankrupt in this environment. Yeah.
Meanwhile, in the metal space, and this has been sort of the ongoing debasement trade and a question around whether it truly is that, you had seen prices go parabolic in silver, truly just shocking gains, particularly over the past week and a half. Suddenly you're seeing a little bit of froth coming off of that, down about 5%, 4.8% now in pre-market trading. But a question here about whether this is real or whether this is speculation. And it comes in the heels of a real question that's been bleeding out in the gold market throughout the bulk of this year.
Yeah, whether or not this is the debasement trade was the subject of conversation in last week's shows that I was hosting, because you haven't seen the dollar really fall that much. I mean, it's like 8% year to date, right? From the peak, it's not even 12%. But the thing is, maybe currencies around the world are also coming down to some extent. So the question is, what's driving gold and precious metals higher? Silver obviously has industrial uses, so it's a different story. But the rally in gold has been eye-popping as well, right? 70, 80% year to date.
Yeah, and some people speculating it could continue based on central bank buying. This really has to do with the geopolitics of the moment, which seem to be in focus, certainly in Washington, D.C., under surveillance this morning, closer than ever for Ukraine.
I really believe we're probably, Mr. President, by far closer than ever before with both parties. If it went really well, maybe a few weeks, and if it went poorly longer, and if it went really poorly, it's not going to happen.
20-point peace plan, 90% agreed, and U.S. Ukraine security guarantees 100% agreed. U.S. Europe Ukraine security guarantees almost agreed. Military dimension 100% agreed. Prosperity plan being finalized.
Here's the latest. President Trump and Ukraine's President Zelensky hailing major progress made over the weekend toward a potential peace deal with Russia. However, talks failing to produce a major breakthrough. Bloomberg's Tyler Kendall joins us now. Tyler, thank you so much for being with us. So do we have any sense of what the progress really was that was made over the weekend?
Hey, Lisa, good morning. Well, at this point, we saw both sides really tout that there is optimism here, right? We know what the big sticking points still remain to be. President Trump yesterday saying that the thorniest issue on the table is, of course, the future of any potential land concessions, as he's previously suggested that Ukraine is going to have to give up territory in the eastern Donbas region as part of any future deal. It is our understanding that there has been an agreement reached in the draft proposal that would include a referendum vote on what happens to that eastern region. But Ukraine needs to see some critical conditions met first, including that Russia would withdraw its troops. The other big part, of course, security guarantees. What are those going to look like? Both sides, again, hailing progress, as it is our understanding, and we reported earlier this month that the U.S. has put on the table something that could mirror NATO's Article 5 mutual defense clause. We are now learning this morning that Zelensky did ask President Trump directly yesterday at Mar-a-Lago for those guarantees to extend to 30 or 50 years. Now, this White House has repeatedly said that responsibility is really going to fall on our European allies, which is why it's important and notable that the pair of leaders did have a call with European leaders yesterday after they met face to face. But to your question, Lisa, one of the biggest questions here is, what is Russia really going to agree to? That is, of course, what we've seen when it comes to engagement on the Ukrainian side. But in his call yesterday with Vladimir Putin, President Trump said that Russia is still not interested in a ceasefire before any potential peace deal. And we've heard openly from Russian officials that there are some parts of this now 20-point plan that are non-starters, including the proposed size of Ukraine's post-war military. I will say in one potential sign of progress, we did hear from the Kremlin that they have agreed to create 2 working groups. That was a proposal put forward by the U.S., and those are the people that are going to run point to continue negotiations between the 3 countries.
Tyler Kendall, thank you so much for that. Cameron Dawson of New Edge Wealth still with us. And Cameron, how much do you count on some of the rhetoric that we've heard over the weekend as something concrete that is, just since this is what we do, tradable in the sense that this could be the emergence from a war state in Europe?
Well, we continue to just watch one thing, which is oil prices and gasoline prices, as far as how much a war in Europe matters for U.S. markets and U.S. earnings. And we continue to be in an environment where gasoline prices are falling. It's pretty incredible. Over the last month or so, we've seen 30 cents off the daily national average gasoline price come out. We're now at $2.80. And that's such a far cry from the high of $5 that we reached in the aftermath of the initial invasion of Ukraine by Russia. So as long as you are in an environment where those energy prices remain contained, it's likely something that the overall market, at least in the U.S., continues to look the other way and not see it as a major driver of impacting returns.
And there's been no impact, even though we talk about Venezuela a lot. Obviously, it's important for foreign policy and potentially human rights. There's been zero impact really on oil, right? We see Brent just creeping above $60, but not much more.
And maybe just diesel prices. That would be the one thing to watch with Venezuela, because they have heavy sour crude, which is very important for diesel production. And so that's been a market that has been a little bit tighter than what we see in just normal gasoline prices. And so as we think about the impact of energy prices, that is a major wild card for 2026. Over the last 3 years, we cannot underappreciate how important falling energy prices has been, not just for headline CPI, but also for the U.S. consumer. It's effectively been a tax cut for U.S. consumers. So each and every month, we've been in an environment where year-over-year gasoline prices have been falling. This is a boon for U.S. consumers. And if it were to turn in the other direction, that could certainly be a headwind for consumption as well as headline CPI for 2026. It's a wild card. It's not our base case because of some of these dynamics of oversupply, but it's certainly not something that we should ignore.
How much is that outweighed, Cameron, by the run-up in electricity prices that the consumer faces, sometimes 200% of what it was a year ago, the run-up in natural gas prices that the consumer faces because that's the dominant power source used for data centers? I mean, AI is pushing up energy across the spectrum other than oil.
And certainly, we're seeing it in elections as well as coming into top of mind for consumers. And so just as they're potentially getting this tax cut on the pump side of things with cars, you're seeing that pressure in overall electricity prices. And there's a great argument that this is what creates the perception of higher inflation than what we might get in overall statistics because of the dynamic of frequency bias, meaning that you go and fill up your car more frequently, you pay your energy bill at your house more frequently. So you feel those prices going up a lot more than you feel the prices going down of certain goods that you buy less frequently, which is one of the reasons why we continue to see this high levels of readings in things like University of Michigan surveys on outlooks for inflation, even though when you contrast that to what the bond market is saying, the bond market continues to be very optimistic that inflation will fall back down towards the Fed's target, with five-year forward inflation break-evens and swaps looking at just about 2.4%. So there is a contrast there into the inflation we feel as consumers and then the inflation that is perceived or expected by bond markets.
Spoken like someone who truly has traveled this season. Cameron Dawson of New Edge Wealth, thank you so much for being with us, and happy holidays and happy new year. Coming up, my conversation with JetBlue CEO Joanna Garrity on how the airline is gearing up for a key year ahead. Plus, Guy Johnson with your morning movers. Silver pulling back after that record rally. Meanwhile, copper surging to new record highs. From New York, this is Bloomberg Surveillance. Good morning. supposed to be that Santa Claus rally time, and we're not feeling it, at least right now. But still, when you take a look at S&P futures, you can see pushing toward all-time highs, even though you are down about 0.25%. And Matt, how far are we away from that 7,000 mark? You've been doing calculations over there.
I'm not a
on your
math
slide
whiz,
rule.
but it looks to me like 1% away from 7,000 in the cash trade because we're at 69.30.
Yeah, this has been another double-digit year. It's been more than 20% the previous 2 years. Right now, we're up some 18-19%. On the NASDAQ, you're up 22% year to date, with people expecting more to come next year, which is sort of the interesting aspect of this. The euro just losing a little bit of luster versus the dollar, still around that 117.63 mark, where it's been hovering for the past couple of trading sessions. A bit into treasuries, down 2 basis points ahead of the Fed meeting minutes that we get later this week, 4.11%. And copper up almost 2%. It was up 5% earlier in the session, surging ever higher. Why, I guess, is the question. Is it physical demand? Is it speculation? Is it a little bit of everything? A lot of people looking to Dr. Copper for some signals.
Yeah, to me, copper is almost more fascinating than silver, right? Precious metals make sense as a safe haven if you're worried about any number of things. But like silver, copper has industrial uses, even more, arguably, and normally you see copper surge when giant economies like China are building ghost cities. They're not doing that right now. I guess we're building data centers, but I wonder what people are using it for.
The reindustrialization of the world, are we seeing it in the price of copper, or is it speculation about the industrialization of the world? 3 hours away from the cash open, here are your morning movers with Guy Johnson. Guy.
One of the reasons why copper might be higher is because people are building a lot of data centers. And that's evidenced in the stories that we're watching this morning. Lisa, let's start with the first one. Digital Bridge Group. So this is a private equity company. Now, remember a few weeks ago, SoftBank sold out of its NVIDIA position. Apparently, there were tears. Now we're starting to see evidence maybe of how that money is going to be deployed. This is a private equity company. It's based out of Boca. It's based out of New York. It's based out of LA. It invests in data centers. And this is why SoftBank is interested in it. The stock is up by 34% pre-market. Advanced talks for SoftBank to buy this company. Now, it has bought private equity companies in the past, hasn't done so for a while. This is going to be interesting to see how this one turns out. So keep an eye on that. Tech generally is a little softer today, though. One of the reasons why some of the futures picture you were talking about, Lisa, just a moment ago, is indicating that we are going to maybe move down. Tesla's one of them, Nvidia's one of them. Nvidia's down by 1.26%. I can't find a decent reason for this other than the fact that we saw a decent pre-Christmas tech rally, and maybe some of the chips are being taken off the table after Christmas, but I can't find any decent reason for it. So let's get on to the metals trade. I'm not going to do copper, but I am going to do silver. Let's talk about some of the silver stocks. First, Majestic Silver. Great ticker, AG, obviously. That is for the periodic table fans. Down by 2.76% this morning. The reason for it? Looks like silver's going to get choppy now. It's had this incredible run up. As you can see, we'll move it on a board and show you what's happened with silver. It's a gold story as well. You've seen it here in Europe this morning with Fresnillo. But you're starting to see silver maybe just moving off a little bit. You can see it over there, just a tick lower. But it's producing a decent response in some of these stocks. But silver's had an incredible run. Year to date, up 161%. So silver's certainly moving some of the stocks this morning. You're also seeing some of the miners moving here in Europe on the back of that copper trade as well. Lisa,
thank you.
Back over to you.
Thank you so much, Guy. Wonderfully said, and everybody's trying to bet on the physical economy heading into 2026. On our radar this morning, President Donald Trump saying Ukraine and Russia are, quote, closer than ever before to a peace deal. Ukraine's President Zelensky calling the framework 90% agreed with U.S.-Ukraine security guarantees 100% set, but warns that clashing over the Donbass region remains a hurdle. And it comes, Matt, right after we saw Russia lobbing a slew of missiles over at Kyiv over the weekend, raising questions about how serious Russia is about some sort of truce.
Yeah, I think it's, obviously it's a horrendous war that has continued for far too long. To me, one of the most fascinating threads was Sergei Lavrov, who I thought had been on the outs, the Russian foreign minister, made a comment over the weekend that Europe is now the problem. He said, since Donald Trump has come into power, the U.S. is no longer the problem. We've fallen into line, right? But Europe still continues to confront Russia in ways that he doesn't like. And I just thought that was pretty telling.
It was telling, and yet you saw rhetoric from President Trump saying that Europe is great, Ukraine is great, Russia is great, everyone's great. And it raises this issue of where is their daylight, right? We haven't really understood what the sticking points are going to be, the 90% done. And also, if it's 100% guaranteed, then that they're going to have some sort of security guarantees. Why not just count on NATO? A lot of questions here.
Yeah, I think the Donbass region is probably the biggest sticking point. How much land Ukraine is going to have to secede, and one of the big problems there is that it may not be legal, even if it's agreed by Zelensky and Trump and Putin. The country may still have to vote on it, and it's very unpopular in Ukraine to cede land.
Yeah, meanwhile, we're really focused domestically on what's going on in the AI space. NVIDIA striking a licensing deal with chip startup Grok. The deal announced just before Christmas looks to give NVIDIA an edge in the AI race, particularly with language processing units. Under the agreement, Grok CEO Jonathan Ross and other executives will join NVIDIA. However, financial details were not released, except that Grok is valued some 3 times what it was a couple of months ago at $20 billion. And it's a non-exclusive licensing deal to try maybe to avoid some of the regulatory or the antitrust concerns, while also hiring 90% of the employees from Grok. I mean, it just highlights what the playbook is for tech giants that have more cash than they know what to do with.
Exactly. That's the most important point. They have so much cash, right? And this is an acqui-hire. I hate that portmanteau, but that's what it's being called, because they're paying essentially $20 billion to get the employees of a company that was valued at less than $7 billion just a few months ago.
Yeah, I mean, this to me is going to be an interesting playbook going forward. And how much can they get away from some sort of regulatory scrutiny and Washington, D.C. scrutiny by structuring it this way? Meanwhile, Bank of America CEO Brian Moynihan saying he expects the Trump administration to de-escalate trade tensions next year.
To go from a 10% across the board to 15% for the broad base of countries is not a huge impact. And that's where our team says it's starting to de-escalate, and that you're starting to see the resolution of the discussions into 15% here, 17, different numbers.
Moynihan adding that China deals are a special case due to the national security interests, rare earth minerals, and artificial intelligence. It does seem, as Matt was mentioning earlier, that we have left some of that behind in terms of trade tensions. What happened after Liberation Day? Well, we kind of just surged from there.
Yeah, exactly. And I mean, Moynihan thinks that or says that Trump is going to de-escalate from 10% to 15%. Well, he didn't mention the fact that we started out at 2%, right? So that's really not a huge de-escalation if you look at it in whole.
Well, and this really goes to the question of how much the consumers are able to absorb, which is the reason why we are watching the travel sector so closely. JetBlue CEO saying the company expects to see the benefits in sales and cost efforts next year. I sat down with Joanna Garrity to discuss the airline's 2026 outlook. Take a listen. I want to start with just how this fits into the strategy of JetBlue right now to make the airline truly profitable for a sustainable period of time.
Yeah, thanks for the question. Great to be here and have you in Blue House, JetBlue's first foray into lounges. This is very much part of our Jet Forward strategy. We've been working very hard for the last several quarters on really turning towards premium and trying to make sure that we're offering more opportunities for customers who want to pay a little more. And the lounge is part of that. Our transition to a first-class product next year, a domestic first-class product, will be part of that. Our Premier card, our Even More as a cabin, and really excited to start seeing all of that come to life in 2026.
All of the big airlines have talked about loyalty and how important loyalty and premium offerings is to their profitability going forward. How is it different for JetBlue? Because there isn't the sort of obvious business customer that typically fuels the loyalty offering.
I mean, we're a leisure carrier. We tend to get, a nice share of business customers because they love the product. We're back at the top for Net Promoter Score, so really proud of that. But at the end of the day, this is really designed around trying to make sure that customers who travel for vacation have a reason to come back again and again, and providing with a little oasis of peace. And really through our loyalty program, we want to reward people who choose JetBlue because they love the product, the service, and what we offer.
You have already offered Mint and other premium rollouts. How has it been going?
It's been great. Mint's been a very strong source of revenue for JetBlue for well over the last decade. And so we're not new to this. We have a brand that, definitely associates with more of a higher end leisure customer, providing more to customers at a very reasonable fare. And we want to make sure that we offer something for everybody across the full spectrum, whether you want sort of a dialed down experience, still free Wi-Fi and great legroom and great snacks and drinks, TVs. But then if you want to pay a little more, you have the opportunity for a lounge, our Mint class for transatlantic, and then then when we launch domestic first later this year, that's going to be a great product offering for customers who want a little more.
So I was shuttled into here through very long security lines and lots of people with screaming children trying to get to different destinations for their warm holidays. This is the busy season. How is it looking in terms of demand, given the fact that there were some hiccups in the past couple of months, but at this point, people are getting back to what they originally had?
Yeah, 2025 has been a very tough year, whether it was the macro setback or the government shutdown or the list goes on and on. We're really looking forward to the holiday season. Bookings are coming in strong. As we go into 2026, we're optimistic that the consumer is healthy and that we're going to start really ramping up the initiatives that we have been working really hard for the last year to execute to and seeing the benefit as we move through 2026.
How long do you think it'll take before you start to actually turn profitable and sustain that?
You know, our goal next year is to break even from an operating margin perspective, and that's the first step back to profitability. We have a great team here. Everybody's pulling for us. We're doing all the right things, whether it's our focus on operational reliability, net promoter score, all of the premium products that we're launching, our laser focus on costs, and really trying to make sure that we're delivering a great product offering for customers, because JetBlue has this wonderful brand and this sense of people want to love us and they want to see us succeed. And 2026 is going to be our year with everything we've put into place.
Because 2025 was not the year for a lot of airlines.
Tough year for airlines.
There were a lot of issues. And you talk about the government shutdown. This has been a big discussion among a lot of the airline CEOs where they've said we just can't make up that kind of revenue. So there will be some sort of hit. Have you disclosed any kind of revenue loss as a result of some of the shutdown?
You know, we haven't disclosed any kind of revenue loss. You know, we've said that we remain on track for Q4, and I think we're pleased with what we're seeing in terms of bookings coming in for the balance of the month. We definitely saw some softness, obviously, during the government shutdown, but we're recovering coming out of that. I think most have shared that. But it was definitely an impact, and unfortunate that the airlines were put, you know, right in the middle of that shutdown. You know, all the great air traffic controllers and the TSA workers, they need to be, you know, cast as essential workers. We really need to make sure that, if anything, this industry is so essential to our economy. I mean, think about all the people who were traveling for weddings and funerals or doctor's appointments that were displaced because we couldn't get on the same page in Washington, D.C. So we're really hopeful that, you know, we've turned a page there and that we can move forward, you know, looking at that end of January date with, you know, a little bit of nervousness. But I'm confident that D.C. will pull it together and get us in the back end of that.
Yeah, you somehow, being an airline CEO probably wasn't in your bingo card that you'd be well focused on healthcare legislation with your fingers crossed heading into January. I'm wondering how much you're hoping to attract a new class of customers versus capitalize on the ones that you have that might be willing and able to pay a little bit more with some of the new offerings.
Yeah, it's a little bit of both. We know we have customers today that want our first class product. And so it's really, you know, offering that to them so that they can buy up when that opportunity presents it. But it's also making sure that we're competitive with the industry. Everybody's moved towards premium. You know, we're going to continue to move towards premium because it is a resilient customer segment. But we're not going to forget the folks that fly in our coach product. I mean, they're just as important. And we want to make sure that JetBlue offers something to everyone.
It really does feel a little bit like the Sharks and the Jets when you speak to some of the airline industry CEOs, where they talk about, you know, it's become a game of consolidation and it's become a game of the big fish really dominating the fields in a lot of different ways. They say it's going to be very hard to be a more budget-focused airline. How do you fight back? How do you sort of create a viable business model at a time when you do see this consolidation of profitability and travel in the biggest airlines?
I mean, it's definitely hard. We talk about the need for a more level playing field. When 4 carriers have 80% of the domestic seats, that's a real problem. You know, we fight very hard in D.C. to try to make sure that we're heard, that the challenges we face, whether it's cost pressures, the lack of scale, the lack of, you know, consolidated purchasing, the, you know, inability to get access to gates. We just bid on a gate, a Heathrow slot, and we were denied it. And so, you know, while I maybe understand why it went to a legacy larger carrier, those are little things that add up over time. And the smaller carriers really need to be given a fair shot to win in this environment. And that's not happening right now. So we're focused on what we can control. We're focused on a whole series of initiatives under our Jet Forward program. It's getting us moving in the right direction. I'm excited about what it's going to bring. But we do need the government to kind of make that a more level playing field so smaller carriers can more effectively compete.
In the meantime, you do have this cooperation with United. You've been expanding in a host of different places. Is that the template going forward? Maybe not consolidation due to the recent issues, but in terms of the previous merger that was denied, but going forward, having some sort of partnership with major airlines to expand the routes.
Yeah, we've got 50 airline partners across the globe, and now we have the Blue Sky partnership with United. That is most certainly a part of trying to provide more utility to our loyalty program and providing a broader global network for our customers when eventually in Q1 they can book a JetBlue flight on United.com and vice versa through our interline agreement. And so we're excited about what it's going to bring. Does it solve the problem fully? No, it doesn't. But it's definitely a meaningful revenue initiative that gets us back moving in the right direction.
Do you anticipate consolidation at any point in your future, or is that sort of on the back burner stuff?
That's on the back burner. We're really focused on JetForward. You know, I'm really excited with the progress we're making. We're seeing it. We're seeing improved operational reliability, improved customer scores. We have not let the grass grow under our feet in 2025. We've executed a whole series of revenue initiatives. We've kept our costs under control despite pulling a 1.5 capacity this year. So 2026 really is the year that we should reap the benefits of all these initiatives that we put into place in 2025.
That was JetBlue CEO Joanna Garrity speaking with me just in the past couple of weeks after opening their first lounge in JFK. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. China is vowing to expand government spending. Beijing plans to boost expenditures and strengthen the spending power of local authorities in an attempt to balance growth and contain debt risks. It plans to spend more on, quote, new productive forces like advanced manufacturing and tech innovation. Meanwhile, President Trump saying his administration knocked out a big drug facility in Venezuela last week. The strike would be the first known land attack on the country since the administration began its campaign against Venezuela. This comes as the president ramps up pressure against the country's president, Nicolás Maduro. And North Korea says it conducted a long-range strategic cruise missile launch drill over the West Sea Sunday as it continues to showcase its weapons capabilities amid regional tensions. The country's news agency says it was carried out to test counterattack readiness and combat capabilities of its long-range missile units. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, the year of dollar softness.
2025 has been a year of dollar softness. The dollar has been softer, but we shouldn't overread that. The bid for U.S. assets, including the dollar, on balance continues.
Bloomberg Scholar Montgomery Koenig joins us next as we look ahead to the possible debasement trade, or is it? This is Bloomberg Surveillance. To get that holiday feeling, that holiday spirit into the equity market right now, not really feeling it. Seeing right now declines on futures, lower by about 0.2% on the S&P. Still, as Matt pointed out earlier, about 1% away from that 7,000 mark as we do end the year near record highs. Meanwhile, a bit of dollar strength here, although just 117.67 on the euro dollar cross, and the 10-year yield getting a bid down almost 2 basis points to 4.11%. Copper, check it out. We have faded an almost 6% rally earlier in the session, now up just 0.6%. To Matt's question earlier, who's buying it? Well, I guess some people are asking that question and fading some of the earlier gains that we had seen. Under surveillance this morning, shifting gears to the year of dollar softness.
2025 has been a year of dollar softness, but most of that dollar softness was built into the first few months of the year. It's really been steady as she goes since the summer. That's noteworthy. It's suggestive of something else we've been saying all along, which is, the dollar has been softer, but we shouldn't overread that. The bid for U.S. assets, including the dollar, on balance continues.
Here's the latest. The U.S. dollar posting its worst week since June, with Bloomberg's dollar index showing the greenback on course for its steepest yearly drop since 2017. Lots of questions around debasement. Bloomberg scholar Montgomery Koenig joins us now. And Skylar, thank you so much for being with us. Before we get to the dollar and the path ahead, I'm curious your view on how much you consider gold and silver when discussing whether we are seeing truly a debasement trade take hold.
Yeah, I mean, I think the one place that you can see investors really pivot away from the dollar is in COFR data. So central bank reserves have pivoted away from the US dollar, but it's not landed in one currency specifically because there is no clear alternative, which is the issue. Now, I bring this up because there's also been a pivot into gold, and I think that's increased enthusiasm for assets generally that are more out of the norm. And for the dollar, it's not a big impact because it's a small flow, but for gold, it is very much a big flow relative because it's a smaller market. So I think it's definitely symptomatic of that trade, but it doesn't necessarily mean that you're going to have big dollar downside because COFR reserves, the share for the dollar has been declining for something like 2 decades now. And you've had big cyclical dollar bull markets in that period. So it's a small flow for the US dollar, especially as it still dominates trade flows, it still dominates financial flows, but it's a big flow for gold.
How much is a weakening dollar a consensus trade heading into 2026?
I think it's more mixed than maybe the headline numbers tell you. What you tend to see actually is at the beginning of the year, if there's not a strong bias, you tend to have consensus go towards dollar weakness. And that's because you've had dollar overvaluation on a number of metrics for a very long time now. Now, I think the issue is those metrics is they don't take into account productivity gains. And so on that measure, you'd say valuations should have a structural break higher because the US has been more productive than a lot of its developed market peers. So I think, when there isn't a clear bias, as we had at the beginning of last year, which was actually for dollar strength, you tend to see dollar weakness come out as the favored trade at the beginning of the year in year ahead outlooks.
I have a pretty smooth brain, so I can't think of too many factors at once. I just look at rates, right? And in terms of the terminal rate that futures are pricing in right now, it's 3%. If we don't go that low, do you maybe get a dollar with more strength than the street's expecting?
Yeah, I think certainly. So there are 2 factors that I'm really thinking about next year for the dollar. The first is that we had this risk premium priced in on Liberation Day. Now, that premium has compressed as some of your more world-listing policies from the U.S. administration has come off. So we no longer have the big threats to the Fed's independence that we had previously. And you've also had more positive growth drivers like fiscal stimulus. Now, I think that compression still has a room to run. And you can see in the gap that's opened up between, say, euro dollar and rate differentials that there could be some move still in that. But I think also, as you say, the Fed is kind of priced at what I would consider as a dovish extreme, which points to rate differentials also moving in the dollar's favor in 2026. The market's still looking for a terminal rate around 3%. That's in line with the Fed's estimate of neutral. So it's arguably a floor for pricing because going lower would imply a recessionary dynamic that would boost the dollar as a safe haven in any case. But a 3% terminal isn't a ceiling for the Fed, I don't think. We've already repriced terminal higher twice this year from the Fed's perspective in terms of you've had that neutral dot kind of edging upwards as the economy is held up very strongly. So I think certainly you could go higher from here, and that skews the risk to being dovish Fed expectations being disappointed, and that's supporting the dollar.
Bloomberg scholar Montgomery Koenig, thank you so much for being with us this morning. And Matt, I should start more of my questions with, I have a very smooth brain. That's fantastic. I love it.
She mentioned productivity and all these other factors, and I'm, as a male, sometimes incapable of thinking of too many things at once, right?
Don't categorize all men like that. No, I can say, I'm going to stand up for the male contingent here. Now, look, there is this question of what is the main driver at any given point. And right now, it has gotten incredibly muddied because a lot of people are talking about rate differentials possibly being the main driver. Other people pointing to the question of, well, is the Fed truly independent? Something that you picked up.
Yeah, I would question the Fed's independence now and especially next year. I mean, what could happen, I think, is still in question.
What could happen is coming up next. We're going to be speaking with Deborah Cunningham of Federated Global Investment, Terry Haynes of Pangea Policy, and Savvy Sith of Raymond James as we dig deeper into the airline sector as we do all travel. This is Bloomberg Surveillance.
Next year, you have the hallmarks of a potentially pretty exciting year.
Balanced portfolios make a lot of sense heading into 2026.
Setting this up for a year where you're going to see a lot of churning, but have moderate returns.
We see a huge amount of appreciation across the AI names. There's a question of which ones and how long can that run for.
Respect the trend, but don't ignore the risks as we go into 2026.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks marching toward new records, but taking a little bit off this morning as traders bet on stimulus and growth. Precious metals in focus with prices of gold and silver dipping a bit after a parabolic rally. Copper, meanwhile, surging on that real world demand. And President Trump closing out the year trying to tie up what has been an elusive peace deal between Ukraine and Russia. Matt Miller in the hot seat today. So glad to have you as we play tag here on Surveillance. John is out on paternity leave. Annmarie is off on vacation. Matt Miller, I am so pleased to spend the next couple of hours with you. I'm just wondering, given this rally is 1% away from all-time highs, what will it take to get it over the edge?
Yeah, well, I think we typically have Santa Claus rally in the last 5 days of December, first 2 in January, that averages a gain of 1.5%. Right now, we're only up 0.3% in the first 2 days of that. So we could still easily get there. And it looks like the market wants to, despite the fact that futures are off a little bit today.
It seems like the bet is on a broadening out, and you are seeing a little bit more of that this morning with the idea of losses in S&P futures and NASDAQ futures, but not necessarily in Russell 2000 futures. And this idea, you need to see that. There has been a shift in the conversation around AI, and I think it's worth mentioning that Grok NVIDIA deal that we saw last week with a question of what this signifies going forward, that NVIDIA is trying to consolidate its market share to get a non-exclusive licensing deal with a company where they're going to hire most of the people and possibly get a more efficient chip to put out there on the docket. It just highlights how things are shifting in terms of narrative.
Well, only a few months ago, industry experts would have told you nobody's even close to catching up with NVIDIA in terms of the technology. And then we got the Google TPU story, which I think changed that calculus a little bit. But look, the M&A is part of the animal spirits. The IPOs we've seen, part of the animal spirits that have essentially eliminated bears from this market. In terms of equities, everyone is a bull.
Yeah, right now, everyone's a bull heading into next year, which raises the question, how much more bullish can people get? And what do they need to see to possibly shift that view? Precious metals highlighting this concern about some sort of debasement trade or haven trade, or maybe it's just the real economy. And what we're seeing there, you are seeing copper prices retreat after being up some 6% in pre-market trading, now up 0.2%, just as people look to some of the stockpiling going on and losing those gains as we speak. Silver, meanwhile, down almost 6% after a rip-roaring record run. And what we have seen in the bond space, and this is interesting, so much depends on next year what happens with the Federal Reserve. The two-year yield started this year at 4.23%. Currently, it is 3.47%. The 10-year is down from 4.55%, currently 4.11%. The best rally right going back to 2017. The 30-year yield started this year almost in the same place that it is now, around 4.8%. Matt, it just highlights how you can move the front end, but the long end rests on something completely different.
Yeah, absolutely. And I tend to broaden out my look at rates to at least November when we had the election, right, and to September when the Fed started cutting. And if you look at it over that time frame, you've seen an even bigger rise in 10-year yields. So I know that this administration wants to get the 10-year yield down. They want to get mortgage rates down. They want to lower interest rates for companies that have driven a lot bankrupt, but they haven't been successful thus far.
Meanwhile, right now we are looking at a pretty quiet week as we head toward that New Year's celebration on Thursday. Thursday will be a closed day. I'm sure everybody is going to be traveling and enjoying their families. We are going to be getting, though, tomorrow some meeting minutes from the Federal Reserve. We're also going to be getting jobless claims later on this week on Wednesday. A real question here about any read or tell from some of the information that we're getting, given the fact that people say the GDP print from last week or the jobs report that we did get from the previous couple of months have been so messy that you have to wait until early in January to get a cleaner read. Coming up this hour, Debbie Cunningham of Federated Hermes as Wall Street pushes for a year-end rally. Terry Haynes of Pangea Policy as Nancy Pelosi predicts big Democratic wins in 2026. And Savvy Sith of Raymond James as holiday flight cancellations deliver a costly blow to airlines. We begin this hour with stocks holding near record highs as we start the final trading week of 2025. The future of the Federal Reserve very much in focus. Bank of America CEO Brian Moynihan saying an independent Fed is critical for the health of the markets.
They're a lender of last resort. They're there to stabilize markets and price. But other than that, you shouldn't know they exist, quite frankly.
You don't worry about all this, hand-wringing of political interference with the Fed once that new position is.
The market will punish people if we don't have an independent Fed, and everybody knows that.
Debbie Cunningham of Federated Hermes writing, while the Trump administration attacks in the committee have intensified worry in the financial markets, we believe the Fed will prevail. This does seem to be the preeminent belief right now in markets. Debbie joins us now for more. Debbie, why do you think that the idea of Fed independence is kind of behind us and that people have sort of closed that story out in 2025 and look to a sort of more normal Fed in 2026?
Well, I think what we saw in 2025 was a surprise and then ultimately a divided Fed. We still don't know the full ending to the Lisa Cook story. We do know the ending to what the Supreme Court has thought about as Fed independence and a different type of body compared to some of the other ones. We saw President Trump go from, supporting Chair Powell to trying to fire Chair Powell to being told he can't fire Chair Powell to submitting to trying to find other replacements for him, interviewing replacement candidates for him for his expiration of his chair term in 2026. So I just feel like what we've seen so far has been a bit of a upheaval and turmoil within the Fed, that now that the independence has been, solidified, I think that will not be the case going into 2026. However, what I do think will be the case is that we see less voting that is all in alignment. I think we will see more dissents. We've already started to see them in the last three meetings. And I think that will probably continue. And, what we've seen historically as hawks, centrists, and doves will become even a little bit more pronounced in their voting.
So do you think, Debbie, that people are overpricing the chance of rate cuts next year?
I think they are, at least from what the Fed is telling us with their dot plot, their series of economic projections. They are looking for one. Our official call right now, as we transport into 2026, is for two, one in the first half, one in the second half. But I think ultimately, although the pace of lowering rates has modified from where it was when we started 2025, the ultimate terminal rate, Lisa, seems to be the same. I mean, it's not going below 3%. And that's where I think the bond market is settling in. That's why you see, the 10-year rallying at various points. That's why you see a range trade that is really more indicative of actual technicals and market conditions, as we head into year-end supply and demand, repo market, issues all seem to have more of a influence on rates on a day-to-day basis for this, last trading week of the year. But ultimately, when you look at the terminal rate for the Fed, over time, it's still at 3%. It's just 3% a year earlier.
I wonder how you view liquidity right now, given your position, and given that we're now have eclipsed $8 trillion in money markets. It seems like there's a lot of cash sloshing around the system. And we have pretty decent growth, right? Even though it's hard to look at these economic data points, 3.8% GDP, maybe only 2.6% inflation. What's your view on sort of the macro picture?
I think the macro picture at this point is that the worst is behind us. We really, when we went into 2025, were toying with the potential before some sort of a substantial growth slowdown into a potential recession. That's behind us now, though. At this point, we think the worst quarter, obviously, was the first quarter of 2025, and the consumer continues to be employed, so the consumer continues to spend. The consumer is the one driving the economy in this recovery that we have been experiencing. So I think slow growth will be the case. I know not a lot of people like that from an equity market standpoint. It doesn't get the same, sort of splashy results that a faster growth economy does. But I believe that when you look at liquidity markets, when you look at broader term fixed income, slow growth is not a bad place to be, and we've seen that certainly in the gathering of assets in the liquidity market, as you said, recently passing the $8 trillion mark.
Debbie Cunningham of Federated Hermes, thank you so much for being with us, and have a wonderful New Year's celebration as we assess what's going on next year. It is sort of this contradiction, Matt, that we're talking about the potential for slow growth, and everyone's talking about how consumer sentiment is down. And then you saw the GDP print from last week come out, which was the fastest pace in 2 years. And it sort of raises this issue of, are we seeing an economy entirely powered on data centers while human beings kind of wonder what their existence is and wonder what the path is going forward and lose confidence in their futures?
I mean, I find the term K-shaped kind of annoying, but it seems to be prevalent across a range of different industries and paradigms. I mean, certainly in M&A you see it. Certainly in terms of profit growth you see it. Certainly in terms of the consumer you see it. So I just don't understand how 3.75% is restrictive. I mean, are we really looking at a rate that's 75 basis points too high and still growing at a 4% clip?
Okay, so this is the debate, right? For mom and pop stores, not so much. You talk about M&A. Where is the M&A happening? Yes, it's happening across the board. It's happening out of necessity, right? Because companies want to get bigger, banks in particular, also industrials. But you're also seeing the ongoing tech M&A because companies can, right? We talk about NVIDIA and Grok and the $20 billion valuation. They're just sort of minting money. But we also have another deal that could potentially be announced this morning. We're hearing that SoftBank could be announcing Digital Bridge. This question of that race really driving a lot of this activity. Yep. And without that, what happens, right? How much is left? And is it restricted for who?
Right. Without that, you only have the lower half of the K, right? And I guess that's the problem. 17 companies filed for bankruptcy through November. And obviously that's worse than we want to see it. And that's all due to interest rates and inflation. But inflation, I think, is something that you shouldn't forget, right? Because the last print looked soft, but companies still have to pass through more of this tariff costs.
I'm very much with you, and we'll be watching that coming up. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Policymakers for the Bank of Japan are signaling more interest rate hikes are ahead. A summary of the bank's December meeting shows board members raised concern over the benchmark rate, calling it the lowest level globally. Currently, the BOJ's key interest rate sits at a 30-year high. Meanwhile, Ukrainian President Volodymyr Zelensky says he asked President Trump for U.S. security guarantees lasting as long as 50 years. Zelensky spoke to reporters after the two leaders met yesterday in Florida. Current proposals outline a 15-year security term with the possibility for extension. President Donald Trump says Ukraine and Russia are, quote, closer than ever before to a peace deal. Meanwhile, silver pulling back from all-time highs as traders take profits from this year's record-breaking rally. A weaker dollar and rising geopolitical tensions boosting precious metals during the end-of-year rally. Silver is on track for its best annual performance since 1951. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahaira. Up next, winning the House.
So if the Democrats win the House back...
No. When? When the Democrats win the House back, then we will. Right now, the Republicans in the Congress have abolished the Congress. That ends as soon as we have the gavel.
Terry Haynes of Pangea Policy joins us next as we preview 2026 in Washington, D.C. From New York, this is Bloomberg Surveillance. Good morning. to get that Christmas and New Year's and holiday spirit into the markets right now. The Santa rally kind of fading just a touch, down about 0.2% on S&P futures. You see a bigger move on the NASDAQ, although Russell 2000 about flat in early market trading. Meanwhile, just a touch of dollar strength after a pretty weak month. We are seeing 117.59 down by about 0.1%. The euro versus the dollar cross a stronger dollar. Meanwhile, 10-year yields down about 2 basis points to 4.11. They have declined from some 4.55% at the beginning of this year. And copper coming off some of the earlier highs. We saw that up now 6% in pre-market trading. Now we're only up 0.3%. A real question of Dr. Copper. Is there a tell here? Who is stockpiling copper? Is it all of us as we build out data centers? Under surveillance this morning, a focus in Washington, D.C., winning the House.
So if the Democrats win the House back.
No. When? When the Democrats win the House back, then we will. Right now, the Republicans in the Congress have abolished the Congress. They just do what the president insists that they do. That will be over. That ends as soon as we have the gavel.
Here's the latest. Former Speaker of the House, Nancy Pelosi, predicting congressional success for Democrats in next year's midterm elections. A recent Gallup poll finding Americans' approval of the current Congress is at just 17%. Bloomberg's Tyler Kendall joins us now for more. Tyler, as we set up into next year, the midterm elections seem to already send a message to Washington, D.C. How have you seen the messaging shift from both sides ahead of the midterm elections?
Yeah. Hey, Lisa, good morning. Well, that polling that you just showed is pretty brutal, but it does highlight the fact that this Congress has only passed fewer than 40 bills so far this year, which hovers near record lows. So you've really seen Democrats on one side try to highlight what they say should be other policies put forward, but that their hands are tied because they don't control both chambers of Congress and the White House. And the White House try to tout what they've already put into effect, right? We heard President Trump tell Politico on Friday that the midterms are going to be all about pricing, in his words. As we've spoken about multiple times on this program, the administration has tried to shift the messaging when it comes to the issue of affordability. And you were just discussing that GDP number from last week. President Trump coming out and touting that growth while we've seen consumers really remain downbeat. That means that we're going to see the potential for a few different policies going forward here, right? Republicans want to tout what they've already done, including many of them saying that we're going to get large refunds come tax season. Many of them also floating that we could see another reconciliation package next year. But there are also going to be those big headwinds. And that's what Democrats have been highlighting, including that we could be staring at another government shutdown come January 30th. And there still hasn't been any movement when it comes to a potential health care deal. Lisa, I'll give you the upshot here, which is that Democrats only need to net 3 seats next year in order to flip that chamber. That is how slim the margins are. We are talking about the House, but also worth mentioning in the Senate. The math's a little bit more tricky, but Republicans have seen some senators in key seats say that they're not going to run for re-election, like Tom Tillis in North Carolina and Joni Ernst in Iowa. Those were some seats that Republicans were banking on.
Tyler Kendall, thank you so much for that. Right now, Terry Haynes of Pangea Policy joins us for more. Terry, it does seem like 2025 was the year of Trump. President Trump dominated a lot of the news. We did not see a lot of congressional action. How different will 2026 be?
Well, I think people in markets feel that they're pretty well worn out from 2025 and the kind of Washington action they saw across the board. I told markets that I thought 2026 was going to look like a frenzy because you'd see Trump and Republicans doubling down on what they did and do the maximum amount of possible to make sure that they put the best case before the public, that they ought to continue with a Republican trifecta in Washington.
Hey, I thought it was interesting, Terry, that Trump and the party kind of campaigned on an anti-neocon, like we're going to focus on domestic issues and get out of foreign policy disasters. And now they focused almost solely on foreign policy and are bombing different countries. And it looks like now maybe even a land strike on Venezuela. Does that continue into 2026?
Well, I think they'd dispute the premise. Certainly, the big beautiful bill is about domestic, and to the extent it's about international, it's about making sure that that what you get in in American industry is reshoring and a much better and bigger defense industrial base. But I do think you see continuing that pretty muscular foreign policy because that's part and parcel of what the competition with China is all about.
So do we get in? I mean, it looks like we may agree to a 30 to 50 year commitment in Ukraine. At least those are the reports from Zelensky this morning. And do we get in a land war in Venezuela, or do we attempt regime change again in South America?
Well, I think what you're seeing on both the United States and China's part is grasping for, pushing against kind of hemispherical dominance around. Certainly a lot of what China does in the South China Sea and beyond is about hemispherical dominance. Pushing on Russia and Europe on trade is about hemispherical dominance. The China being the biggest trade partner of South America is about hemispherical dominance, and it's a big reason why Trump and the Congress both are focusing on pushing back against that, whether you're talking about what happened in Argentina, what is happening in Venezuela, what happened in Colombia, and so on.
We heard Nancy Pelosi talking about how Democrats are going to take control of Congress come 2027, certainly the 2026 midterm elections. There is this question about what the Democratic agenda really looks like. And there's been a battle for what priorities the Democrats really want to put forward. How different are they from what President Trump is doing?
Well, they're different in a lot of ways. I think Mrs. Pelosi, of course, is in her exit interviews phase, and you're a leader of a party. You're always closing, right? You always be closing, and But I would say to you a couple of things, Lisa. One is that it's way premature to suggest that Democrats are going to take anything over. Simple math is when you've got at least 10% of the seats up for grabs through retirements and whatnot, and you need such tiny margins to hold. Right now, almost a year out, anything could happen, and that certainly wasn't the plan in 2016 that Republicans were going to hold both houses, and yet they did. That said, I think that Democrats, frankly, want status quo more. On margin, what Democrats want is going to be less desirable by markets because it's just going to pile on more debt and deficit. That is what the progressives in the party want that have the energy and the money in the party. What Republicans are trying to do, not cheerleading for him, but I'm just saying, is trying to figure out ways to lessen debt and deficit to some effect, and show markets that, frankly. And Bessent has said that this is a 3 or 4 year process, but he's hoping that they can get there by the end of it.
So, Terry, you don't think that they're going to sign off on $3,000 or $2,000 checks come early next year and expand the deficit?
Oh, I think there will certainly be some deficit expanding actions taken. It'd be naive for anybody to think that politics is about some ideology, and fundamentally these days, I think it is not about ideologies. Certainly, if you accept the premise that Trump bestrides Washington, then you're seeing a fairly non-ideological president. But I think they'll cut some checks? Yeah, I think they probably will. Do I also think that they have it in their ability through a couple of different times in a couple of different ways through the winter and spring to do something about Obamacare that lowers the debt deficit? Yeah, I do that too.
Terry Haynes of Pangea Policy, thank you so much for being with us, and have a wonderful New Year celebration. Coming up, more from our conversation with legendary investor and co-founder of Oaktree Capital Markets, Howard Marks, plus Guy Johnson with your morning movers. SoftBank in advanced talks to acquire Digital Bridge Group. Those shares up more than 30%. From New York, this is Bloomberg Surveillance. Good morning. a bit of a soggy start the last trading week of 2025. We are seeing futures lower on both the S&P and the NASDAQ, about 0.2% loss on futures in the S&P. NASDAQ down 0.4%. Russell kind of catching up to that, or catching down, I should say, down about 0.1%. Still, we are up 18% on the S&P so far this year. Matt, what are we? 1% away from that 7,000 mark?
Yeah, on the cash trade, I think we closed at 69.29 or 69.32, around there. So about 70 points away from 7,000, which isn't meaningful in any other sense than it's a big round number. So if we hit that by the end of the year, I think markets would be pretty excited.
Yeah, they're hoping for that Santa rally to get to that big round number. Meanwhile, the big round number in 2s, 10s, and 30s is that yields have actually gone down considerably this year, at least in the 2s and 10s denominations. You are seeing on the front end of the yield curve, we started the year at 4.23% on that 2-year. Now we're seeing 3.47%, down a full basis point. 10-year yields started the year at 4.55%. We are currently below 4.11, down 2 basis points. The 30-year yield has basically been pinned at this 4.8% level. 2 hours away from the cash open. Let's head over and get your morning movers with Guy Johnson over in London. Guy, over to you.
Morning, Lisa. Metals and tech. Those are the two themes you need to think about first thing this morning. So let's start with the metals, then we'll do the tech in just a second. So silver. We know it's down this morning, but it's had a great run. So silver stocks have had a great run as well. AG, this is First Majestic Silver Corp, just one of a number of silver names this morning, therefore pre-market that is giving back a little bit of ground. People are talking about a bit of choppiness in this space. Gold had a great run. The miners did well on the back of that. And you can see silver, look at that run that it's had, particularly at the back end of the year. Just beginning to give a little bit of that back now. Are we going to see some choppiness going forward from here? Are those stocks going to be reacting? 160% to the upside on silver year to date. That's a phenomenal move. Okay, so let's stay with the metals theme, but kind of go from the top to the bottom in terms of the table, right off the bottom, in fact, and deal with uranium. This is Energy Fuels Inc. This is a company that is based out of Denver. It is a company that mines in Arizona and mines in Utah. It does uranium and it also does rare earths as well. This morning it's out with news that it's doing well on the revenue and the sales front when it comes to the uranium sales story. Why is this important? Uranium stocks have had a fantastic run this year. Why have uranium stocks had a fantastic run this year? Because uranium goes into nuclear power plants, which goes into data centers via the electrons that flow out of them. So that takes us to the data center story. It's all related into this narrative. And that takes us on to our last one, which is Digital Bridge Group. Remember, we saw SoftBank selling out of NVIDIA a few weeks back. We're now starting to see maybe some distribution of that money. Advanced talks, we understand, for SoftBank to acquire Digital Bridge. What is Digital Bridge? It is a private equity company. It's based out of Boca. It's based out of New York. It's based out of LA. What has it invested? Yeah, you guessed it. Data centers, amongst other things. And the Advanced Talks story this morning, driving this stock sharply to the upside, as you can see. We're up by, let's call it a third, 33%. Lisa, back to you.
Thank you so much, Guy. Great work, as always. On our radar this morning, President Trump saying he made a lot of progress in talks with Ukrainian President Volodymyr Zelensky over a possible peace deal this weekend. Zelensky asking the United States to consider providing Kyiv with security guarantees that would last 30 to 50 years. Also, President Trump holding another high-profile meeting in Florida today, this time with Israeli Prime Minister Benjamin Netanyahu. The two aiming to boost a U.S.-brokered ceasefire in Gaza, which faces challenges as it moves into its second phase. And lastly, silver pulling back from all-time highs as traders take profit from this year's record-breaking rally. It's on track for its best annual performance since 1951, rising some 161%. Meanwhile, copper surging to a fresh record close, extending a stunning year-end rally fueled by concerns over tighter supply. Markets are capping off a year of seismic shifts, from the dominance of AI to historic trade tensions to the Fed's independence under threat. Earlier this month, I spoke with Oaktree co-founder Howard Marks about his latest memo exploring if there's a bubble in artificial intelligence. Take a listen.
The unproductive bubbles I would describe as financial fads. Portfolio insurance was one, subprime mortgages was another. Financial activities that become fashionable, zoom into popularity, get overhyped, and then recede. But then there are bubbles which are based on technological progress, starting with the steam engine, the railroad, the radio, the automobile, computers, internet, et cetera. And these actually push society ahead and change it irreversibly. But in the process, there's a bubble surrounding their implementation, which is overly accelerated and overly financed and goes to excess and end up destroying a lot of capital, but leave society greatly changed. And I'm sure that AI is in the latter category in terms of effect on society. And the question is, will the implementation prove to have been excessive in scope and in the way it's financed?
Just because something is excessive doesn't mean that you can't invest in it.
No, but you know, when investors hate everything and won't touch it with the 10-foot pole, chances are it's going to be on sale because nobody has pushed up the price. In fact, their disinterest has pushed down the price. But when everybody likes something, is excited about something, chances are it may be overhyped and overpriced. So you just have to be careful.
So that's where we are right now. You said you can invest and you can participate, but you just have to be careful. What does being careful look like? Does it mean focusing more on debt versus equities, more on equities versus debt, more on small companies versus big ones? What does that look like?
Well, what I say in the memo is that it's okay to lend for activities, even if they're uncertain, but not if the outcomes are purely conjectural. I mean, in order to be a smart lender, you have to have good visibility on the extent to which the thing is likely to repay interest and principal. If it's just purely conjectural, it's not. You shouldn't be a lender. And in fact, I think the memo says that where that's the case, you should actually, if you want to participate, you should be in the equity, so at least you get the upside. The lender has no upside. You make a 9% loan, all you're going to get is 9%, no matter how well the thing does. You certainly shouldn't do that in activities that have a high probability of not paying off at all, because then you have unlimited downside and limited upside. That's absolutely the wrong combination.
So you think right now, in some circumstances, the equity might actually be a better option than the debt because of that potential upside?
Yes, exactly, because the point is that if you go into some startup which has let's say a small possibility of a raging success, you wouldn't lend to it because you have a high probability of losing all your money and no probability of participating in the success. That's a bad trade.
So you always talk about this risk-reward pendulum, the risk and fear, the sort of fear and greed pendulum right now. And yesterday we saw Oracle come out and talk about having to borrow more money, having to spend more, and people are selling off the shares. Does this make you feel good? Does this make you feel like there actually is some discretion?
Well, yeah. Well, I think that it's Buffett says, the less prudence with which others conduct our affairs, the greater the prudence with which we must conduct our own affairs. So when other people are acting imprudently and mindlessly and carefree, we should be worried. When other people are showing appropriate concern, that's a positive sign that the market is applying some discipline. Some of the greatest moments that I've seen, some of the greatest signals of danger in the markets have been when people were not applying any prudence at all, like in 2006, for example. So if people are reacting harshly to aggressive, possibly risk indicating activities, yes, that's a healthy sign. And this market seems healthier than the 2000 market to me.
How concerned are you that we get a Federal Reserve that's more accommodative for a variety of reasons that leads to even more risk-taking? This idea that not only did the Fed cut rates, indicated more rate cuts, but also is adding to its balance sheet in a way that could potentially prop up demand.
Well, I was thinking about this when I was waiting to see you today. Most of the people listening to this program, including me and you, are interested in the free markets, and we think free markets should set the prices of things. And the Fed manipulations are a form of price controls. They control the price of money. And if the Fed puts money artificially cheap, then it induces behavior like risk-taking, It forces people into riskier activities because the returns on safe activities are so low. It tends to reinforce the view that there's a Fed put, that if there's a problem, the Fed will solve it, and that contributes to risky behavior. These are all bad things. And, I believe that the Fed should be passive most of the time and only come to the rescue if the market is, if the economy is seriously overheated and tending towards hyperinflation, or seriously underactive and not creating jobs. I don't think that's the case right now. I don't think and you can see in the divided open market committee that there's a difference of opinion. So I don't think that action on the part of the Fed is compelling right now. And, there are people who think that rates should be a lot lower than they are today. I just don't see the merit in that.
Right now, going forward, I remember back in 2015, 2016, 2017, when rates were incredibly low, you were saying people just need to lower their expectations for returns.
Right.
Because ultimately, you have to look at the risk-free rate, and you don't want to reach too much at a time where people are greedy.
Right.
Where are we right now in terms of what types of returns people ought to expect based on the current income rates?
Well, the lower base interest rates are, everything scales off that. So, the Fed funds rate at 3.5 is below history. These are not high rates. They're only high relative to the last 15 years. But this is a low rate. So everything scales off that. Most things will give moderate returns. In the debt area, I think prospective returns are moderate, okay. Not lush, but not inadequate. The trouble is that the S&P, based on its PE ratio relative to history, appears to be priced to provide a very low prospective return. Historically, if you bought at this PE ratio, your return over the next 10 years averaged in the very low single digits. So I think we're in a moderate return scenario. The problem is that how do you get a high return in a moderate return scenario? And most people's resort is to take a lot more risk. And that's something I don't like to do, other than when it's compelling.
You had a personal note, an addendum at the end, and we led off with that idea of what artificial intelligence and machine learning will do to the labor market. It's something clearly on the Fed's mind, clearly on investors' mind. You're talking about concerns that there is going to be cannibalization from human jobs. Right. How do you see this playing out? How are you kind of grappling with this when you look at investments, when you look at fiscal deficit, when you look at the backdrop for the financial system?
Well, look, Lisa, here I'm not talking about investing or economics. I'm talking about society. And it's very worrying to me. And, I've gotten some very nice response from people I respect to the memo. And one of them said he thinks we've seen this in response to the Internet over the last 25 years. But it has not raised unemployment because the Internet eliminated white-collar jobs that were replaced by blue-collar jobs, like, people who pick stuff in warehouses and send it out in e-commerce. So job count is not down, but job quality is down. And I think that this is very worrisome. And as I said in the addendum, when we lost jobs to automation and offshoring, I think that coincided with the opiate epidemic, and not only in amount, but also in location. And I think it's a natural consequence of people sitting around all day. And even if we can find a way to replace their income, I worry about purposelessness. And, we get so much from our jobs other than a paycheck. And you can't replace that stuff.
Wise words from Oaktree Capital Management co-chair Howard Marks. I could listen to him all day. Such deep thinking at a time when everybody is banking on the artificial intelligence trade and wondering what it's actually going to do going forward.
Yeah, I think first of all, I could listen to him all day as well. And he's an incredibly smart man who says some really prescient things. I think in terms of artificial intelligence, for me, when I try and link it back to the market, the most interesting thing will be how damaging it is to software companies. And, you know, venture capital tends to invest very heavily in software companies because of the model. It's much easier for them to predict out revenue streams. But a lot of those companies will have lunch eaten by AI, because why would you buy a pre-programmed package when you can program it yourself?
Yeah. Meanwhile, up next, we're going to be talking about the resilient traveler.
Demand has been, resilient. Right, every time there's cold water poured on the environment, it seems like travelers want to come back.
More from the conversation with American Airlines CEO Robert Isom coming up. This is Bloomberg. A bit of softness this morning that does deepen, particularly at the Russell 2000 ahead of the open. A little bit of a bid into treasuries. I guess people trying to reassess ahead of 2026. Under surveillance this morning, the resilient traveler. Airlines are in the midst of a record-breaking holiday season. Sat down with American Airlines CEO Robert Isom, and we asked him about consumer demand. Take a listen.
You'll see us open up more secondary cities in Europe. You'll just see us do more flying into the hubs of some of our partner carriers. And international will probably outgrow what we do from a domestic perspective, but the two are connected. And, I'm really pleased with our domestic operation. We're going to always have the best domestic network. And, you go back, a number of years and domestic, outperformed international. And we're going to be ready for domestic doing well and international doing well, premium doing well, and really pleased with where we're at.
You've been working on upgrading the entire fleet, and that's something that's been really important for you, especially as you get some of these premium offerings in place. How much have some of the slowdowns, supply chain issues at Boeing and Airbus hampered that ability to really retrofit some of the fleet?
Well, where we stand today, we have the youngest fleet in the industry. We made a tremendous investment from about 2014 to about 2020. And we brought on well over $30 billion of new aircraft. So we have the youngest fleet in the business right now. But on top of new deliveries that we're taking, we don't have any retirements planned. So we're reconfiguring our 777-300s and our 777-200s. We're putting flagship suites on those. Even domestically, we're doing work on our 320s and 319s. But we still depend on new deliveries. And from that perspective, we have a lot of dependence on Airbus to deliver the 321 XLRs, Boeing to continue to deliver the MAX 8s, and hopefully be ready to deliver the MAX 10s that we have on order in 2028. Right now, my only push to the OEMs is deliver on time, deliver a quality product, stick to it. Before you ramp up, let's make sure we can do what you're on the books to deliver now.
Just taking a step back, in the airline industry more broadly, there's been this huge focus on the supreme product, the luxury product. And I wonder what you see in terms of bookings next year, whether it really is the premium product that's continuing to lead and the robustness that you see there while other things fall off. Is it bifurcated in terms of the bookings and the demand, or do you see a wholesale sort of rejuvenation in the interest in travel and ability to spend and pay the prices that actually are there?
Well, I'll just start with this. Demand has been resilient. Right, every time there's cold water poured on the environment, it seems like travelers want to come back, as evidenced by bookings for the holiday season, and as we take a look into the first quarter of next year. I have confidence, though, that overall people want to travel. And in people wanting to travel, I also think that, whether you're more economy focused and budget minded or your premium services, everybody wants more. Everybody wants better control. Everybody wants more comfort. So I don't think that there is going to be any going back in terms of offering product at any level of the spectrum of offerings. But for us, as we go forward, you'll see us with our lie flat seat offering. That's going to grow by 50% over the next few years. Premium seating, 20% over the next few years. Whether you're a business traveler who've always wanted, more of that, comfort and ease of touch, or you're a leisure traveler, there's much more of a demand to really have a better experience.
That was American Airlines CEO Robert Isom earlier this month. And joining us over the weekend has been a number of people who could not get where they wanted to do. Airlines ran into some challenges over the weekend as winter weather led to cancellation of more than 1,500 flights. Savi Sith of Raymond James was delayed. She is now on the phone. She did write, though, earlier, we estimated each canceled flight typically costs airlines $40,000 to $65,000 in lost revenue and incremental costs. Savi, who was on one of those canceled flights, joins us now by phone. Savi, is this typical of the winter season? Is this something that is surmountable given the difficulties that airlines have had so far this year?
Hey, good morning, Lisa. Yes, doing some deep research here in Detroit, but this is typical. We always kind of plan for winter disruptions. The nice thing about winter, at least, is that you see it coming and you can plan a little bit ahead. But there's always disruptions. I think the good news is if you look at how the cancellations are going, most airlines are recovering fairly well. It doesn't help travelers that are stranded or get their travels delayed, but airlines are recovering fairly well, and that's good news. And you're not seeing any meltdown so far.
So how bad is it this year compared to last year and the year before? And how do you factor that into your earnings estimates?
Yeah, so this year it's interesting. There are some airlines like JetBlue that are seeing kind of fairly elevated levels of cancellations and higher than last year. Delta more recently with this weekend weather hit in the Northeast and the Midwest is starting to see a little bit of pickup and so slightly up year over year. But there's interesting ones like American that's actually seeing fewer cancellations this year than last year. So it really does vary across airlines. And for the most part, I think investors will look past some of these kind of weather-related events and will be focused on just how demand is holding up as we look into 1Q in 2026.
Are there airlines, Savi, that deal with it better than others? Are there airlines that make the consumer experience better than others, or are they all awful?
What I would say is this year we've seen everybody handle it fairly well. There are some airlines like Delta or Allegiant where, they do kind of compensate passengers better. But again, I think for passengers, it's less about compensation and more about how quickly they're able to recover. And unfortunately, during the holiday season, planes are packed. It's really hard to reaccommodate passengers very quickly. But again, going back to the fact that the recovery from these cancellations seem to be fairly quick, that's a good sign for travelers. And we're seeing it across the board for most of the U.S. airlines. So it's a good sign overall.
Savi Sith, we wish you luck getting to where you need to go. Savi Sith of Raymond James, thank you so much. It is usually a pretty miserable experience, certainly if you ever get canceled. Have you ever gotten canceled?
Yeah, but travel in general. I mean, if you're flying in luggage class, it's horrible, no matter which airline you're on.
Well, if you want to make it more fun, add some young children. That's what I've heard.
Yes.
I think that always makes it a lot more fun. Coming up next hour, we've got Jay Pulaski of TTPW Advisory, Dana Telsey of Telsey Advisory Group, and Veronica Clark of Citigroup as we do look ahead to Fed meeting minutes as well as jobless claims. From New York, this is Bloomberg Surveillance. Good morning.
Next year, you have the hallmarks of a potentially pretty exciting year.
Balanced portfolios make a lot of sense heading into 2026.
Setting this up for a year where you're going to see a lot of churning, but have moderate returns.
We see a huge amount of appreciation across the AI names. There's a question of which ones and how long can that run for.
Respect the trend, but don't ignore the risks as we go into 2026.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks marching toward new records, but stalling out just a bit. Although traders are betting on stimulus and growth in 2026, prices of gold and silver dipping after parabolic rallies. Copper, meanwhile, surging on real-world demand and a focus on the consumer during the shopping and traveling season, with economists looking to January for a cleaner read on economic growth. Matt Miller in the hot seat alongside me. And Matt, it does seem like people are looking to get a cleaner read in January. Nonetheless, we do get some signs today from the meeting minutes coming out tomorrow, as well as jobless claims on Wednesday.
Yeah, I mean, we'll get a little bit now, and jobless claims, I'm going to say they'll be between 210 and 230,000.
Blowing my mind.
But no, we've had such messy data, right? The inflation data I find difficult to believe, although maybe I'm wrong. The growth data also was incredibly strong, but very backward looking. So we need more.
And it seems like right now a lot of people are counting on the Fed, as well as potentially the one big beautiful bill and the stimulus checks that people get in the form of tax breaks come early next year, to really fuel this rally and needing it to broaden out. Because right now what we have seen so far in 2025 is something of a repeat from what we've seen over the past couple of years, which is the dominance of tech names. It's starting to shift, though, the narrative just slightly around the edges.
Yeah, you're starting to see a slowdown in, although still incredible growth, Mag 7 earnings, and a little bit of catch-up, hopefully, for the S&P 493.
Yeah, at the same time, you're wondering how much this is a debasement trade, how much this is just the real world, how much the precious metals are giving a sign, or whether this is simply just an aspect of this particular rally and is one of the new hotspots. Right now, you're seeing copper join that rally, up almost 2% in pre-market trading. It had been up almost 6%. It just raises this question, especially as you see stocks off by about 0.25%. You see a bid into bonds. Is this a haven trade? Is this a talk about some sort of reacceleration of industrials? I mean, a lot of question marks around this one.
Yeah, there are, and it's also going to be very light trading. I mean, you and I are at work, but many people are not this week.
No way.
And then you tend to see some swings or moves that don't necessarily make a lot of sense. I have faith that Santa will come.
Oh, is that right? You're still waiting for Santa?
Yes.
Okay.
I mean,
2026?
We've had a couple of good days last week, and we could have some good days this week. I think because there are so many bulls in this market, we've got to be up by January 3rd.
You heard it here first from Matt Miller, who's still waiting for Santa Claus. Coming up this hour, we've got Jay Pulaski of TPW Advisory, with stocks trading near all-time highs. Danny Telsey of Telsey Advisory Group breaking down the retail sector, and Veronica Clark of Citigroup expecting unemployment to tick up in December, and we get those numbers in January. We begin with this hour with stocks edging lower, with precious metals turning rather volatile. As Matt was saying, not a lot of people out there, so maybe that's part of the issue. Jay Pulaski of TPW Advisory writing, we think next year might be the year where the downside of a smaller U.S. trade deficit manifests in a weaker U.S. dollar. A weak dollar should support commodities. Jay joins us now. Jay, thank you so much for being with us. Happy holidays. Let's start with that. I think it's a really important point, this idea that what we're seeing in commodities has to do more maybe with the dollar than it does with some sort of broad-based industrial demand. Can you explain?
Thanks, Lisa, and great to be with you and Matt. And I wasn't planning on working until I got the invite to come on and be with you folks this morning. So I agree with you, Matt. But to your point, Lisa, I think people have kind of abandoned the idea that the tariffs would have a big impact on markets. And so I think it could be a surprise when we think of risks for next year, because we are pretty constructive. When we think of risks, we worry about higher inflation driven by the fact that we have to restock now fully tariffed goods. And then the idea that we have a smaller U.S. trade deficit, which leads to less money being available to come back into the U.S. from foreigners and buy U.S. treasuries, which could suggest that maybe we have further backup in long rates. And the combination of those two things, I think, is what could challenge equities at some point in U.S. equities in particular, at some point in 2026, namely rates going to a level on the long end that worry growth investors and put a cap on the upside of U.S. equities.
Why haven't we seen this so far, Jay? I mean, this is something that people have been talking about all year, that what we've seen in the metals space really is a debasement trade of the U.S. dollar, and yet we've seen the best returns for U.S. treasuries going back to 2017. Can you square that circle?
Yeah, I mean, treasuries, okay, they've had the best year since 2017, but they're up about 6%. So we don't really pay much attention to that. We believe that commodities have a real valid reason for their performance over the past year, and we think that performance is going to continue. And that is the fact, very simply, that digital eats the physical, right? So we all talk about AI. Without physical, without silicon, without copper, without water, without aluminum, you don't have any AI. So we have been and remain bullish on the miners. We've had a position in copper miners all year. We hold that position. We think it's going to continue to do well. And we're also very constructive about energy, particularly oil, which is a segment of the market that people don't like. So we like things that people are already invested in, as well as things that people have yet to cotton on to.
Hey, Jay, how do commodities play into equity rally expectations? I mean, if we have a continued rise in the BCOM and if oil actually gets a bid, how does that work into, the bullish forecast for equities next year?
Yeah, well, Matt, the thing that really counts for equities is earnings, right? And so for all the talk about uncertain data and questionable data, market doesn't care about that. The market cares about earnings, and earnings have been good, and earnings are forecast to continue to be good. Look, we are running the U.S. economy hot. We are stimulating in China to defeat deflation. We are stimulating in Europe to build up defenses. And so there's a lot of fiscal spending going on. We're still in a global rate cutting environment. These are the things that support commodities, and they also support emerging markets. We think 2025 is going to go into the record books as year one of the first year of a significant shift in global equity leadership away from the U.S. to the rest of the world. EM equities outperformed the S&P. They doubled the S&P. They're up 32% year to date. And for the first time in my memory, really going back to the beginning of the EM age, EM have better fundamentals, better macro fundamentals than DM. They have better growth, lower inflation, lower debt levels. And so we think, and by the way, expected to have better earnings growth than the U.S., both in 2026 and in 2027. So we think we are at the early stages of a significant multi-year period of EM and non-U.S. equity outperformance. We pair that with the commodity side. We're deeply underweight fixed income, and that's really been the setup for us for about 18 months. It's worked out well, and we think it's going to continue to work out well. We are at the beginning of big moves in EM equity and commodities.
So you like EM. What about EU? Because it's been shocking to see the gains, even in local currency, right? The DAX up 22, 23%. The IBEX in Madrid up like 50%. And if you're a dollar investor, it's been even better. Does that continue? Because I don't really see the drivers there.
Well, we've talked about European banks on this show for many, many times.
Banks,
Lisa
yes.
knows for sure. And EUFN is up 60% year to date, massively outperforming U.S. banks. And guess what? The top 7 European banks traded a 60% discount by market cap to the top 7 U.S. banks. Again, just an illustration of how much room we have to go. The U.S. outperformed for 15 years. And so there's just massive gaps in terms of valuation, in terms of relative upside. And for the first time, Europe is actually doing things, because we're making them in the U.S. under this administration, doing things to control their own fate. And you talk about how the European markets have done. Here's a really interesting stat. For a euro-based investor, the S&P is up less than 3% this year. Okay. And this is why we think that the flow into U.S. assets is going to start to reverse. People talk about U.S. exceptionalism. We think it's coming to an end. As I said, EM has better fundamentals. And so there's an opportunity, we think, in Europe and in Japan. But our preference is where we're most heavily overweighted is in emerging markets, both in China, very bullish China. And again, Lisa knows we've been bullish all year, massively outperformed the S&P, and we're very bullish Latin America, and in particular, Brazil. We think Brazil is setting up to have a major rate cutting cycle, and we like Latin America quite a bit.
Yeah, Jay, I was going to ask you about China, since I know you have been bullish all year and you have done well with that particular trade. How much is this a tactical trade and how much is this a structural trade where you think that China is essentially going to win the AI war?
Yes, all of the above, Lisa. We think there's really three reasons to be constructive on China. The first is that China's fighting to defeat deflation. And as it succeeds, and we think it will, that's going to be very constructive for corporate earnings growth. The second is that we think there's a rapprochement going on between the U.S. and China under this administration. We wrote our whole monthly about it up on Substack. Trump embraces the tripolar world. And so that rapprochement, when Trump visits China in the spring, we think will include a signal for U.S. investors to buy Chinese equities. And for the most part, U.S. investors have not, particularly institutional, have not been active in China equities since the first Trump term. And then the third and most important is what you brought up about AI. We think very simply that China's lead in electricity and generating electric power and its open source AI is a combination that's going to be more successful globally than the U.S. combination of fossil fuels and closed source AI. We really think it's the quantity of electrons are more important than the quality of semiconductor chips. And this is, again, why we think Chinese tech is so compelling. It trades at about a 50% discount to the U.S. It's completely owning the China tech stack. China has made the decision, in large part because the U.S. has forced it to make the decision, that it's going to develop its own tech stack. It's well on its way to doing so. And the open source model allows China to embed AI into the physical. So it's called embodied AI. It's the digital AI plus the physical robotics, and it's leading to autonomy and the focus on autonomous vehicles and autonomous systems. And that's where we think the real story is going to be in 2026 and 2027. And China is way ahead of the U.S. on this front.
Jay Pulaski, thank you so much for being with us and for taking a break of your break to join us. Jay Pulaski of TPW Advisory. We appreciate you joining us. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Israeli Prime Minister Benjamin Netanyahu meeting with U.S. President Donald Trump at Mar-a-Lago today to discuss issues in the Middle East, including Gaza and Iran. The meeting comes as tensions between the two leaders have increased, with Trump having previously warned Israel against taking actions that could undermine his peace efforts, and Netanyahu facing political pressure at home to take a tough stance on Gaza and Hamas. Meanwhile, Chip Wilson, the founder of Lululemon, is launching a proxy fight to remake the company's board. The Wall Street Journal reporting Wilson has nominated 3 director candidates. Wilson reportedly does not believe Lululemon shareholders will trust any CEO picked by the current board and is aiming to change the board before executive decisions are made. And a winter storm is sweeping across the U.S. with a mixture of snow, ice rain, and strong winds. The National Weather Service warning of whiteout conditions and even possible blizzard conditions in the upper Midwest. The storm is expected to produce freezing rain in New England, thunderstorms across the eastern U.S. and south, and widespread strong winds over the next 48 hours. Stay home if you can. That's your Bloomberg Brief. Lisa?
Sounds like a lot of fun. Thank you so much, Yahira. Up next, the morning calls, plus Dana Telsey of Telsey Advisory Group with what to watch for in the retail sector next year. This is Bloomberg Surveillance.
It really is a show me story in 2026 as to whether or not the equal weight S&P 500 can deliver on what are some pretty high expectations for earnings growth next year. A lot is riding on this idea of EPS delivering. And of course, that will be a show me story as we move through the year to see if there is upside to those numbers, or if yet again we'll be in an environment where Mag 7 gets revised higher and equal weight gets revised lower.
That was Cameron Dawson of New Edge Wealth. As everyone looks to that broadening out trade right now in markets on the margins, I guess that the Russell 2000 is performing less badly, but not really. It still has clawed down to meet up with the S&P, lower by about 0.25%, dragged down as the session grows older. The NASDAQ lower by almost 0.5% in early market trading. Time now for the morning calls. First up, Stifel reiterating its buy on NVIDIA, believing its deal with Grok can extend AI infrastructure leadership. Next up, JP Morgan lowering its price target on KB Home to $50, expecting a weak fiscal return next year. Those shares lower by about 0.1%. And finally, Truist lowering its target on Vail Resorts to $234, highlighting a lack of snowfall at its Colorado and Utah resorts. Those shares up by about 0.1%. The snow hit the East Coast this year, not the West Coast, for everybody who traveled out there for wonderful moguls and such. Let's stick with the consumer as focus shifts toward the new year. Data Telsey of a Telsey Advisory Group writing, heading into 2026, we expect events, higher tax refunds, and more accommodative interest rates to drive a continued recovery in discretionary spending, especially among younger consumers. Dana joins us now in person. Thank you so much for being here.
Thank you for having me.
It's wonderful to get your insights as we all look at our gifts from the holidays, decide which ones we need to return. What's your read on how well this season really did perform for retailers broadly across the sphere?
I think holiday season was solid. I think those increases, 3.9, 4.2%, very much in line with expectations. These 10 days after Christmas are very important too, whether for returns, for gift card redemptions, all very important to see what it looks like. But the product newness drove demand, and with the K-shaped economy that we have, you're definitely seeing at the higher end and the lower end looking for value. And that's where you saw some of the traffic, whether it's the Walmarts, whether it's the TJXs. They were there. The last 10 days before Christmas, as always, is where you got the real bump up in terms of top line.
I'm fascinated by the bifurcation between Walmart and Target because I had seen them previously in kind of the same box, but Walmart has done so well this year and Target has disappointed. Why?
I think overall what you've seen from Walmart and Target store standards have fallen. You haven't seen the same innovation and product newness. You haven't seen the same forward momentum of movement, particularly with technology, where Walmart is anticipating what the customer needs. And they really have modernized their whole store format. The Walmart of today is not the Walmart of 5 or even 10 years ago.
If we see a K-shaped economy, do we get Dollar Tree, these Family Dollar kind of discount stores doing well? Because if I look at the stock performance, I don't see Dollar Tree taking off.
I think overall you will see those dollar stores perform. Keep in mind that in 2025, the focus on tariffs, who imports goods from China, was impactful certainly to the dollar stores, and now lapping tariffs should be a benefit to them over time. Who you saw as share gainers, it was all the off-pricers. I mean, whether it was Burlington, Ross Stores, or TJ Maxx, with the diversification of the assortment that they have, they captured customers.
What's fascinating to me is you're talking about how this was a solid holiday season, and yet we're talking about a bankruptcy potentially at the end of this month of one of the biggest retailers, of Saks Fifth Avenue, which faces more than $100 billion of a debt payment. A lot of people are wondering whether that will actually happen. Can you square this story? The idea that we're talking about robust sales, a steady consumer, albeit picky or choosy or whatever you want to say, at the same time that we could see a bankruptcy of one of the biggest retailers out there?
Well, when you think of who's gaining share from that, you look at the new brands that both Bloomingdale's and Nordstrom are putting on their shelves, stocking in their stores. They're gaining share. Just across the street on 59th Street, Bloomingdale's just opened a new extension to their 4th floor with newer brands, whether it's Victoria Beckham, whether it's Valentino, Totem. They have a whole new assortment of goods out there that, frankly, perhaps if not for this change, you would not see those brands in Bloomingdale's. And you're seeing it in Bloomingdale's and in Nordstrom.
How much is this a pattern that you expect to be repeated? That we're going to see wholesale bankruptcies of some retailers that are not keeping up with new product? while others, I'm thinking of Walmart or I'm thinking of Bloomingdale's, continue to gain share. It's sort of the big get bigger, can invest in technology, and you see wholesale bankruptcies on the other side.
Financial leverage is very important in order to keep the operations of a retailer running smoothly. You get into trouble with financial leverage, that's an issue. It always takes a lot to kill a retailer. They don't just die overnight. Take a look, for example, at Blockbuster from many years ago. And certainly we'll have to see what happens with that debt payment of Saks that's coming due very shortly. But certainly when one is weak, others can gain strength. And that's what you're seeing in Bloomingdale's and Nordstrom.
We talk about Bloomingdale's. Obviously, it's a great store. It's an iconic department store across the street here, but it's owned by Macy's. Mm-hmm. And that stock is down 30% this year. Mm-hmm. What's Macy's doing wrong that its Bloomingdale's is doing right?
I think overall, the bold new chapter strategy that the CEO of Macy's, Tony Spring, has put in place, they're making advancements, and you're seeing some change in Macy's also. You look this year at Macy's and what they've done, whether it's backstage with the off-price in their assortment, whether it's what they're doing with luxury, whether it's what they're doing with their own brands, and frankly, the store experience. The investments that they've made into the top 125, 150 stores is outperforming the core. And I think you're going to continue to see the assessment of the footprint of Macy's continue to be architected towards their best performing stores over time.
So you like Macy's? I mean, is this a buying opportunity then, this dip?
I think Macy's is an opportunity. I think when you think about next year and you frankly think about the enhancements that they've made to assortment, both in Macy's and Bloomingdale's, it's not expensive for where it is. And you look at the landscape of department stores that are public companies, it's Macy's, Kohl's, and Dillard's. Macy's has an opportunity on valuation to move higher.
Dana, do you think that early next year we're going to see pretty big price increases across the board for retail goods?
You're going to see more price increases coming, but keep in mind this innovation and newness that we have, you don't have a comparative. So we'll have to see what those prices look like. Consumers are cautious and discerning, but they'll buy what they don't have.
Dana Telsey, wonderful to see you. Thank you so much for being with us today. Happy New Year. Dana Telsey of Telsey Advisory Group. And just want to bring this to you. Evidently, Digital Bridge Group shares have been halted due to news pending. And Matt, this comes with the reports that potentially SoftBank is in discussions to buy this company.
Yeah, that's right. Bloomberg News reporting, according to people familiar, that we could get an announcement as soon as this morning. A more than $7 billion purchase from SoftBank. Of course, that's almost exactly what Masayoshi Son got when he sold his NVIDIA stake. So he said he cried tears at that loss, but now I guess he'll find some joy in buying Digital Bridge, which, interestingly enough, this used to be Colony Capital, right? This was Tom Barrick's shop, taken over by Mark Ganzi after Tom bought Mark's business.
More on that coming up. Tears of sadness turning into tears of joy, as Matt poetically put. Coming up, legendary investor and Berkshire Hathaway CEO Warren Buffett is retiring at the end of the year. We'll take a look back at how he changed investing forever. From New York, this is Bloomberg. Well, a soggy day. I know that Matt is hoping for Santa to come back and steal the day. Right now, not happening. What we are seeing is a little bit of softness, down 0.3% now on S&P futures, grinding lower as the session grows older and bringing along the Russell 2000 as well as the NASDAQ. Although the day is young and there aren't that many people at work, as Matt Miller has mentioned also several times. Euro gaining just a touch, or losing just a touch versus the dollar. The dollar gaining a little bit, 117.63. A bit into bonds, although less than earlier, down 1 basis point for 12% when you round up. And copper now up more than 2% after a rip-roaring rally. Focus very much on deals this morning. 1 hour away from the cash open, Guy Johnson has some really interesting morning movers. Guy, over to you.
Really interesting. Father Christmas definitely coming, Lisa, for Digital Bridge Group's shareholders. Looks like the stock is now halted. Looks like we are going to get some news this morning. This was on a report that we heard earlier about the fact that there was advanced talks between SoftBank and Digital Bridge, which is a private equity company based out of New York, based out of Boca, based out of LA. It does data centers. As Matt was saying a little bit earlier on, remember that SoftBank sold out of NVIDIA to fund these kinds of acquisitions. We're now starting to see evidence of that. And the stock is up really strongly. Halted, as I say. We'll wait for that news maybe to come out a little bit later on in the morning, but the stock's certainly popping on the back of that. For one group of shareholders, Santa Claus is still very much in action. Let's talk about some of the other metals. You were mentioning copper just a moment ago, Lisa. Let's talk about silver. We've talked about some of the silver stocks. Look, I think you're going to see some volatility around some of these names. This is Majestic, First Majestic Silver. You're getting this in other stocks as well. This morning, you're getting in some of the gold names too. The stock is down by 4.3. What you've had is a big move up in silver. We're now down, let's call it circa 5% on silver this morning. It looks like the correlation between obviously what is happening in the physical market and what is happening in terms of the movers in some of these stocks is pretty well aligned, and you're getting a big drop this morning in some of these silver stocks, some of the gold names, some of these stories represented around the world. And as it is the season for stretchy pants, I thought we'd finish with Lululemon. Chip Wilson, the founder of Lululemon, launching a proxy fight. He wants to get a few seats on the board. He's looking for 3, I think. This is a Wall Street Journal story that's been reported in the last few minutes. The stock's not moving much on the back of it. We're down by around 0.2%. But after Christmas, Lululemon feels like an appropriate stock, maybe, that we should be looking at. Lisa, back to you.
Guy, thank you so much, although some would argue that stretchy pants are always in fashion, that maybe they should be used for other purposes as well. Meanwhile, I did want to mention this because as Guy was talking, we did get some breaking news that Digital Group will be acquired by SoftBank for $4 billion. This is a 15% premium from where it closed on December 26th. Digital Bridge will continue to be separately managed and will operate as a separately managed company. They are going to be bought for $16 per share in cash. This according to a statement, and we will wait for those shares to start trading once again, but largely expected, Matt. As we were reporting, Bloomberg reported, speaking to people familiar with the matter, this was the plan, possibly with that cash that Masayoshi Son got from selling his NVIDIA shares.
Yeah, that's right. He got, I just went back and looked, $5.83 billion for selling his shares in NVIDIA. He said that he actually cried when he made that sale. And now he's going to use almost all of that money for Digital Bridge. Although it's interesting, Digital Bridge shares in the pre-market were up at 1.54%. So this 15% premium is going to be a disappointment to some of the speculators that were active in the pre-market this morning.
Well, we will check back when the shares are resumed trading once more. In the meantime, we wanted to take a look back at one of the most legendary investors. Berkshire Hathaway CEO Warren Buffett is retiring at the end of this year. Here's how the Oracle of Omaha changed investing forever and what's next for the company he built.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a $1 trillion conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway and left everyone with one massive question. Warren Buffett is one of the richest people on Earth, but his lifestyle doesn't exactly scream it.
He lives in Omaha. He lives in the same house he's lived for many, many years.
Holiday sausage muffin with...
He goes to McDonald's in Omaha. A lot of people around the city know him.
He's paid just $100K and has been paid that amount for years. That's very refreshing when you think about the landscape today.
So what's the backstory? Well, Buffett's childhood fascination with money led him to Columbia Business School, where he studied under a renowned educator.
Benjamin Graham was a financial analyst considered to be the father of value investing.
Value investing is really this idea that you're not just betting on some fluke in the market. You're really looking at what you think it's worth versus what the value that the market is providing. Ideally, you want to buy a company that you think is undervalued and that it's going to rise in many years. But that requires a lot of due diligence. That requires you to make sure you actually understand how the business works.
I'm not buying them because I think they're going to go up next year. I'm buying them because I think they'll be worth quite a bit more money 10 years or 20 years from now.
Investment after investment, that strategy came to define Berkshire Hathaway. But let's see it in action by focusing on just one.
American Express is an investment that he's had for decades, and when he bought it, the stock price was a bit down because of a scandal at the time, but he saw the value of Americans that kept swiping those Amex all over the place.
That was back in the 1960s. But look at this. Berkshire's current Amex holding was largely assembled here in the 1990s for about $1.3 billion. Since then, Buffett's largely left that core stake intact. But Amex's market value has soared in the years since, making his 22% holding worth tens of billions of dollars.
He was interested because the company has a good moat. By moat, he means some competitive advantage against other companies in the business.
For Amex, that moat is a mix of its premium brand, affluent cardholders, and a network built around their spending power.
Another kind of edge you can have over your competitors is regulation.
Think about the energy business. A lot of those have advantages that a competitor couldn't come in and easily take the market share. That's really helped his business sustain itself. He's built up companies that are not so easy to replicate.
But perhaps the most underappreciated force behind Berkshire's rise is its insurance business.
They're not always the companies that are going to draw the hype from stockholders, but it's actually been a force that's built up Berkshire a lot.
The insurance business provides us with float, and float is money that we hold that doesn't belong to us.
The way it works is it has a very large insurance arm that has a lot of money from policyholders. They have to invest it to reap some benefits and make sure that they can pay claims afterwards. Berkshire Hathaway has been ramping that up to the max, buying a lot of insurance companies and using that money, the float, to invest afterwards.
This is actually one of the hottest plays in the investment world right now, with a lot of private equity and alternative asset managers either buying or having relationships with insurers.
While Buffett has been the face of Berkshire Hathaway, he long had a sidekick. Both conveniently available as lovingly hand-rendered plushies.
Charlie Munger passed away in 2023, but the dynamic he had with Buffett for many years was one of the main draws of Berkshire. They were a unique pair. If you saw them sitting together at the Berkshire annual meeting, they would banter.
I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is
Munger was fundamental to Buffett's investing thesis. At the start of his career, Buffett was very into this idea of cigar butt investing, in which you would take a company, you'd take one last puff, and you'd get what you could out of it before it sort of faltered. And Charlie was one who really reshaped his thinking into thinking about companies that had a longer term advantage.
He went from buying companies that were, not very famous, like Berkshire Hathaway, a textile mill that was struggling, to taking stakes into Coca-Cola or Bank of America.
Not that this approach is always a sure thing.
One is IBM, when he bought a stake in the early 2010. He said afterwards that it was a big mistake. He didn't see how IBM was about to lose the turn of the industry towards cloud computing.
He also orchestrated the merger of Kraft and Heinz about 10 years ago.
It just hasn't gone to plan. Part of that is down to changing consumer tastes, consumers wanting healthier things. Part of that is down to inflation. And Buffett commented recently that while he didn't think the merger in hindsight was a great idea, he doesn't think that undoing it is going to fix the company's problems.
And lately, Buffett has struggled finding companies he wants to invest in, leaving Berkshire with a record amount of cash.
It is so much easier to make very successful bets when you're managing 100 million, 200 million. He's now got a cash pile that's more than $300 billion.
And finding a place to put that capital to work is getting really difficult. He doesn't like to have money that is sitting around and not earning more money.
Higher interest rates these past few years have turned that cash pile into a nice income generator.
But it is going to get harder and harder to deploy that level of capital the bigger it gets.
So this is the Berkshire Hathaway Greg Abel is inheriting as the company's new CEO. Although sadly, we don't have a plushie of him.
He led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic. That's part of the reason that so many investors have always made that trek to Omaha despite the cost, despite the distance.
Abel will also be taking charge at a time when Buffett's hallmark strategy is being tested.
It is tough to be a value investor when what's really lifting the stock market is high growth companies. The tech company's valuation might be really high compared to sort of what the underlying assets are. While Buffett has bet on technology in recent years, his misses on those opportunities will always sort of linger.
The change in leadership also risks reviving a long-standing debate.
A conglomerate is not a thing that has stuck around. We've seen many conglomerates, such as GE, fall apart in recent years and sort of be split up.
Buffett's presence at Berkshire won't be disappearing overnight.
He'll remain as chairman, and I think his influence will still be felt by the company. He's a major shareholder of the firm, and while he's slowly divesting that stake and giving it to his children's foundations, I think his legacy will long be felt.
But Abel will be taking over many of his duties, including the writing of Berkshire's annual letter to shareholders.
This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
Shares of Berkshire Hathaway are up nearly 10% as Warren Buffett wraps up his final year as CEO of the company. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. She'll be there in just 1 second as we parse through the breaking news of what just happened with Digital Bridge. Let's head over to Yahira right now.
Hi, Lisa. We start with Ukrainian President Volodymyr Zelensky saying he asked President Trump for U.S. security guarantees lasting as long as 50 years. Zelensky spoke to reporters after the two leaders met in Florida yesterday. Current proposals outline a 15-year security term with the possibility for extension. President Donald Trump says Ukraine and Russia are, quote, closer than ever before to a peace deal. Meanwhile, 2 helicopters crashed mid-air in New Jersey over the weekend. 1 person was killed and another was critically injured, according to authorities. The FAA saying the helicopters crashed moments after taking off from the Hamilton Municipal Airport. The FAA and NTSB are investigating the collision. And in sports, the New England Patriots have clinched the AFC East after a 5-touchdown performance from Drake May, edging out the Buffalo Bills, who lost to the Eagles. Elsewhere, the 49ers beat the Bears in a thrilling matchup among the NFC's top teams, with the number 1 seed still up for grabs. And the Pittsburgh Steelers and Baltimore Ravens will face off in a winner-take-all game next week for the division title after Pittsburgh lost to Cleveland 13-6. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, setting you up for the day ahead. Plus, Veronica Clark of Citigroup expecting the unemployment rate to tick up in December. From New York, this is Bloomberg Surveillance.
In my mind, there's too much fascination with the Fed. We're a country that's driven by the private sector. The idea that we are like hanging on the thread by the Fed moving rates 25 basis points, it seems to me we've gotten out of whack. They're a lender of last resort. They're there to stabilize markets and price. But other than that, you shouldn't know they exist, quite frankly.
So you don't worry about all this, hand-wringing of political interference with the Fed once that new position is.
The market will punish people if we don't have an independent Fed, and everybody knows that.
Is Bank of America CEO Brian Moynihan over the weekend. Right now, it seems like the market is just softening, looking for that Santa Claus rally. Heading into year-end, just about 1% away from that 7,000 mark. What you are seeing softness in S&P futures. You are seeing a bit of a continued sell-off in small caps. Russell 2000 down 0.4% after being flat just a couple hours ago. NASDAQ down 0.7% in the bond space, 2s, 10s, and 30s. You are seeing a bid across the board, including in the 30-year space, which hasn't seen love this year, stayed around the same level going back to earlier. Right now, we're seeing two-year yields at 3.47% rounded up. That is down from 4.23% at the start of this year. I do want to just mention DigitalBridge. SoftBank has agreed to acquire the firm for $4 billion. It is a 15% premium to the close on December 26th. Those shares had been up, as Matt was mentioning, more than 50%. Now they are up about 10%. They have resumed trading. We will get you an update on that in a bit. Counting down to the opening bell, here's your trading diary for the week ahead. At 1 p.m. Eastern, President Donald Trump meeting with Israeli Prime Minister Benjamin Netanyahu. Tuesday, ADP employment data, Fed meeting minutes. Maybe we'll get some read on the January meeting. And on Wednesday, we get jobless claims. Thursday, everyone is off. Turning to some of the data we'll get to kick off the new year. Veronica Clark of Citi writing, we continue to expect another slight increase in the unemployment rate to 4.7% in December. Veronica joins us now. Veronica, thank you so much for being here.
Thanks for having me.
Happy holidays.
Happy
I'm just
holidays.
wondering from your perspective, how much the data that we got earlier this month was actually valid and that people are discounting it too much.
Yeah, I think there's a lot of that going on. And if we saw the unemployment rate next Friday, the first week back to work, if we saw that at something like 4.7, I think people will believe it a lot more because, there's a lot of issues with the November, October data. We don't know how much the government shutdown affected the measurement of those months. But December should be relatively clean. And if it stays pretty high, I think that's a more concerning sign for people.
How come this labor market is weak? I don't get it because you've got incredible earnings growth, right? So corporate America is doing very well, and there are no new people coming into this country, right? There's no immigration. The demographics trend, like everyone's old. There are no young people. Like it should be companies are fighting for employees.
Yeah. I mean, there's been this, issue of, is it labor supply? Is it labor demand? We've been dealing with this for a couple years now. Back in 2024, when we saw the unemployment rate increase, the excuse was also it's more immigration. I don't think we can use immigration to explain the bad data, different sides of immigration to explain bad data. But I think what's happened is that labor demand has just weakened more than labor supply. And that's why you've seen the unemployment rate rising. It's this low hiring, still low firing dynamic. But I would be worried that low hiring can only last for so long before maybe you do see some layoffs.
So is that because technology and AI have made the few employees that companies hold on to more productive?
I'm a little hesitant to conclude that that's what's happening now. That might be part of the story, absolutely, and we could see larger productivity gains from AI longer run. But this really started a couple years ago. This really started maybe summer of 2023 when we saw this pullback in hiring. And I do worry that it started in more rate-sensitive sectors like manufacturing, small businesses. The pullback has really been there. And so, it doesn't necessarily matter if equities are doing well and earnings are fine. Small businesses are going to be more rate-sensitive.
Aren't we bringing manufacturing back? I thought we were bringing manufacturing back, right?
We have been losing manufacturing jobs, I think, every month this year. But that predates this year also, and it is a rate-sensitive sector.
Well, this sort of speaks to the question of, is the Fed restrictive? And this is the big debate. Restrictive for who? Because on one hand, you do see companies filing for bankruptcy at the fastest clip going back to 2020. On the flip side, you see AI companies screaming ahead. DigitalBridge bridge being purchased for $4 billion at a 15% premium. So can you square that?
Yeah, I mean, there's this bifurcation across all parts of the economy. I think there's a lot, that has already been said about the K-shaped economy for consumers. Higher income consumers are spending, but we definitely see that in sectors also. And the smaller businesses who are more rate sensitive, I think rates are restrictive here.
So you expect a significant number of rate cuts. Let's just postulate that we do see an increase further in the unemployment rate to 4.7% as you expect. What does that mean for January 28th?
Yeah, I think they're going to be cutting.
Really?
Yeah, so we are penciling in another cut in January, another one in March. And it's just this kind of idea that you've clearly gotten more concerned on the labor market side of your mandate if the unemployment rate is something like 4.7 that we think we'll see in December. We will have hopefully more inflation data by March that we trust again, early 2026 data. If you're seeing inflation slowing and data that you believe again, and you're less concerned on the inflation side of the mandate, you're more concerned on employment, why wouldn't you be at the midpoint of neutral, which would be cuts in January and March to get you there?
The counter argument is if you get rate cuts, potentially 2 by the end of March, at the same time that you have the one big beautiful bill, the tax refunds, and potentially an additional $2,000 stimulus or whatever else might be coming down the pike, don't you risk reigniting inflation that never died?
Yeah, I'm not so concerned about that right now. The inflation driven by lower rates, more stimulative monetary policy, you would expect to see it first in a sector like housing, and you definitely don't see that yet. You don't see those signs yet. Home prices have been slowing. New rents have been slowing a lot. We already know that in the inflation data, there's this lag issue of shelter inflation. That's going to, I think, be slowing all of next year. All of the potential fiscal stimulus, maybe larger tax refunds, the business tax incentives that were part of the bill from the summer, those can help support growth. But I would worry that the main determinant of if people are spending or not is if they have a job and what their labor income is. And that we have seen slowing already. And you would think consumption would slow then too.
Veronica Clark, thank you so much for being here and for holding down the fort for the economics team at Citigroup. Veronica Clark of Citigroup Global Markets. It is going to be interesting next year on January 8th, I believe, when we start to get the December data that people think is actually the clean data, how much it gut checks or confirms what we've already seen.
Yeah, I'm looking forward. I'm actually excited to get CPI because the last reading we got included some zeros from October. I'm not an economist, so I don't get why they did that. But it feels to me like we're still looking at inflation that's 50% above the Fed's 2% target. I haven't experienced the $2.82 gas prices that we keep hearing about.
Well, maybe you need to travel out west to Iowa or somewhere where there is a low gas price. What we are going to be speaking about tomorrow, we do get some ADP numbers as well as, of course, the meeting minutes from the last Fed meeting. We'll be speaking with Kayla Sater of State Street, Mark Cabana of Bank of America Securities, Dana Doria of Investnet, and Chris Marr of Ocean First Financial from New York. This was Bloomberg Surveillance. Good morning.